There's obviously a lot of fear out there in the market, and the fear is centered on uncertainty.
So long as we're in this environment where consumers don't know the rules, businesses don't know the rules, you're going to be challenged for a while.
So far, the threat of tariffs has been a blunt instrument.
The size of the tariffs and the speed of them, it really dwarfs anything that we saw last time around. And I think markets are reacting accordingly.
It will take a few months to see how these policies pan out.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday following another volatile session on Wall Street, equity futures pushing higher this morning after briefly dropping as much as 10% from all-time highs. We're once again waking up to more trade headlines, 25% levies on steel and aluminum coming into effect with the threat of much more still to come. The latest moves leading to more downgrades on Wall Street. Goldman cutting its forecast on the S&P to 6,200 from 65. Pointing to a, quote, recently reduced GDP forecast, a higher assumed tariff rate and higher level of uncertainty that is typically associated with a greater equity risk premium. Our next stop for this market, CPI at 8:30 Eastern Time. Another read on U.S. inflation.
The reason why this is so important is because the increasing fear right now is stagflationary-like trends. This idea that you get GDP that gets downgraded, to Goldman Sachs' point, but inflation that is sticky, that is reducing the reaction function of the Federal Reserve. And that is the reason why yesterday you saw markets respond more, at least bond markets, to the JOLTS data than they did the uncertainty of tariffs.
Elevated uncertainty in the last 24 hours. Earlier this morning, the ECB President Christine Lagarde delivered a speech, called it the era of shocks, and had this quote: "The trouble with our times is the future is not what it used to be." How many times did the future change in the last 24 hours?
A lot. We whipsawed back and forth. It was a roller coaster of tariff headlines, and honestly, one that it's very difficult to see. A lot of his advisors signed up for that ride based off some of the reporting, trying to push back and regulate Trump and some of his approaches when it comes to trade, especially when it comes to Canada. The Wall Street Journal editorial board this morning says this: at the end of the day, the two sides did start talking. There's a temporary truce, but who knows which side of the tariff bed Mr. Trump will wake up today. And that's the uncertainty that is bleeding into this market.
If you want clarity, you're not getting it right now, and you certainly didn't get it yesterday on steel and aluminum. We had the tariffs on those metals changing multiple times, Lisa, and this is the confusing part for businesses who sat down with the president yesterday in the business roundtable. When's that clarity going to come, if at all?
What's the goal? I would take it a step further. It's one thing if you don't have clarity about the method. It's another thing if you don't have clarity on the goal. What was the goal of upping the tariffs on Canadian steel and aluminum to 50% from 25%? And simply say that the more that you reciprocate some of the tariffs that we do, the more that we're going to amp the ante here. How much does that achieve a goal that we understand? And without that in mind, the uncertainty is existential because it's unclear whether tariffs are just tariffs for tariff's sake.
The president will constantly take a maximalist approach, which we saw him do yesterday. If the goal was just to have Doug Ford come to Washington, D.C. and meet with Howard Lutnick, I don't think you needed to put out a tweet saying we're going to have 50% now on Canada's steel and aluminum. At the end of the day, though, there was a truce, but you can see the writing on the wall. Regardless of what country it is, regardless of what industry it is, this is going to be the playbook for the Trump 2.0 administration.
Equity futures right now on the S&P positive for now. We'll see if that sticks. We're up by 0.7% on the S&P 500. Coming up on the program through the next 60 minutes, we'll catch up with Max Kettner of HSBC as trade headlines whipsaw markets worldwide. Adam Posen of the Petersen Institute as 25% steel and aluminum tariffs go into effect. And Sheila Kahyaoglu of Jefferies as airlines signal a dire outlook for the consumer. We begin this hour with stocks inching higher, looking to snap a two-day losing streak. Markets whipsawed by tariff headlines, leading to several downgrades for US equities from Goldman, from Citi and from HSBC. Joining us now from HSBC, Max Kettner. Max, welcome back to the programme, sir. The facts have changed. Talk to me about how the outlook might have changed as well.
Yeah, look, I think we're still tactically quite cautious on equities overall, particularly, of course, in the US. We've just put out a note this morning. I think this is the kind of time where you need to update your framework, your indicators pretty much on an hourly basis, because like you guys were just discussing, of course, even yesterday, things were changing pretty much 3 times during the day. So when we look at our indicators at the moment, particularly from a systematic perspective, of course, yes, there has been quite a bit of systematic selling, But what we're not yet seeing is this sort of final puke. So when we look, for example, at our momentum and /CTA indicators, they are bearish. They flipped from maximum bullish to bearish, but they're only at sort of medium bearish levels until now. So we need, I think, for us to be comfortable to go back in and to buy the dip, I think we need a bit more sort of a puke moment in equities to really say, right, this is the all clear. Now positioning is clear enough. Systematics have sold enough. And of course, from a fundamental perspective, what's changed in the outlook, so the stuff that you were alluding to, is, we were all thinking there is some sort of put from the new US administration. With that absent, it is down to the Fed put. But of course, with data, let's say like yesterday, like the JOLTS data, all services, ISMs, or payroll still pretty okay. In a normal environment, that would be really bullish for equities and for risk assets overall. For the current environment, however, it just puts the Fed put even further away. Remember what Powell was saying on Friday. We're in no hurry at all to do anything in rates. So what we would need is the Fed to give some kind of nod to tightening financial conditions, that they're monitoring market developments, something like that. But as they said on Friday, I think we're still quite a bit of way off there.
Max, a lot to unpack there. Let's start with the technical term puke. What does the cathartic puke look like? We had a 10% decline at one point in yesterday's session, so entered correction territory briefly. If it's not that, what is it?
I think what we need to see is broader based. Even on Monday, right, breadth actually wasn't that bad. It wasn't like it was all 500 stocks going down. It was still pretty sort of focused and pretty concentrated in some certain sectors, in the high multiple sectors. I think what you would want to see is sort of the final broad-based puke, where it's not just, tech and the high multiple stuff that gets hammered, but really the broader market, where perhaps even the equal-weighted S&P underperforms the cap-weighted S&P. What you would want to see is that spilling over into credit spreads as well, right, where we haven't really seen a disorderly widening as well, and maybe even spilling over into other equity markets, where then people say, you know what, so far we've been hiding out in European equities, we've been, thinking that this is a completely different story, but now we're really playing US recession fears, and that should spill over into global equity markets. Once we've got that, I think that is then sort of the final puke. And another cue to watch perhaps is the momentum factor. When we look, of course, in US momentum, that momentum factor has been absolutely slaughtered the last 3-4 weeks. Any kind of bottoming there, any kind of a sign of a reversal there, I think is another sign where we can start buying the dip.
I think this conversation needs a bit of antacid. And Max, I am curious about whether we're talking about sort of the market equivalent of the economic debate here, of whether we're pricing in stagflation or pricing in something more like a recession. And that was something Julia Emanuel was talking about. What are we pricing in currently? What would you take more seriously right now at a time where there are a lot of anxieties, but there still are people who are hopeful that we could emerge from this?
I think stagflation fears were about a month ago, right? That was basically when we had January CPI, particularly underlying inflation, much higher than a lot of people, including myself, expected, where, super core inflation was really coming in quite a bit hotter. That really was a month ago. When we look at the last 3 weeks, the amount of selling that we've seen in cyclicals versus defensives, particularly in the US, the amount of decoupling between US cyclical defensives against European cyclical defensives, or really rest of world cyclical against defensive performance, clearly tells us what the market is playing now, in particularly the last week and a half, is increasingly recession fears. So I think we are getting closer to the point where you want to start buying that correction. We're not just quite there yet, because I think, again, it would be different if it was just the high multiple stuff, but we're starting to see that spill over into other parts of the market. It's just not quite there yet, where we can really sound the all clear on the systematic positioning unwind being completely over.
This is a complicated story. It's not just about recession and recession fears in the U.S. It's also about relative valuation and the fact that suddenly there is an alternative, and the idea that Europe looks brighter, especially with the likelihood of some sort of fiscal package being passed. How much do you lean into that, and how much do you say what a lot of people have said on this show over the past couple of days, which is that's looking pretty expensive, that's looking pretty bought, that's already over?
I mean, for one, what is amazing is think if 2 months ago, if at the beginning of January, just before inauguration, if we had said, I think German small and mid caps or European small and mid caps are the, quote, relative safe haven in global equity land, I think you guys would have thrown me out of this room now and would have said, maybe don't come back again. So it is quite funny how things have changed only within a couple of weeks. I do agree with you. It is perhaps the DAX is not the right place maybe anymore. I think it's perhaps in Europe really the small and mid caps that should benefit the most from perhaps, the fiscal package in Germany getting over the line. Also perhaps any potential kind of positive news around Russia, Ukraine. All of that is really particularly beneficial for the smaller and mid caps, but also for other parts of the market. We look at China. I think the China internet, the Asia's tech trade, that still has some room to left. So it's not like we have to throw in the towel on equities entirely, right? It is so far mainly a US story. And I think in Europe, yeah, fine, the higher euro, the stronger euro, I think is starting to get felt in the larger caps, particularly in the German equities, given that they, basically generate only or less than 20% of their revenues outside of or inside of Germany and about 80% outside of Germany. So the stronger euro will start to weigh on the performance there. But the smaller and mid caps are, I think, really the ones that you want to look at. Also, the banks, right? We could look at European banks, still really good. European insurance, right? So there's a lot of stuff even within Europe, also from a sector perspective, under the hood, that is worth looking at.
Max, an incredible 24 hours for Europe, potentially one step closer to peace on the continent. At the same time, you wake up and you see these retaliatory countermeasures to U.S. tariffs. What narrative do you think will prevail?
Look, I think the narrative clearly for the US is that put from, or that we thought was there from the US administration. Either the strike price is much further away, or maybe that put doesn't even exist because they want to force in the Fed put. So I think that narrative, particularly for US risk assets, and frankly at some point also for globally for risk assets more broadly, will really prevail in the next couple of weeks. Because ultimately, for a sustained reversal higher, we will need to see some kind of nod from the Fed to say, okay, you know what, we are monitoring financial conditions, we are monitoring market developments. And let's remember that was actually already enough in the December 2018, January 2019 episode. They were starting to cut rates only in July 2019, but in January we already had that bullish reversal because all the Fed had to do is to say, well, financial conditions are, quote, notably tighter than they were in September. That's all they had to do. They only had to say notably tighter. And already markets were saying, that's the Fed put, that's it. So we're not talking QE, we're not talking emergency rate cuts. What I'm talking about is literally just like a verbal nod from the Fed that we need. And that already, I think, from a fundamental perspective, would that change that narrative that we've just been talking about.
Hey, Max, appreciate it. Thanks for the update. Max Kettner there of HSBC on the equity market. The Federal Reserve decision a week today. Later this morning, 8:30 Eastern Time, US CPI. So look out for that. That's your data point of the morning. Let's give you an update on news elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just hours after Donald Trump's 25% tariffs on steel and aluminum imports went into effect, the EU launched countermeasures against new U.S. metal tariffs. The EU plans to impose its own duties on more than $28 billion worth of American goods. The EU will immediately begin consultations with member states. The tariffs are expected to start next month. House Republicans passed a bill to keep the government open past a Saturday shutdown deadline. The bill will likely need the support of at least 8 Democrats in the Senate to become law. If a shutdown goes ahead, the White House Budget Office would decide which federal workers are furloughed and which essential staff must continue without pay. Elsewhere, Chinese authorities met with Walmart executives to discuss the company's negotiations with suppliers in China over price cuts due to increased U.S. tariffs. The authorities warned that Walmart's demands could fracture the global supply chain, hurt the interests of both U.S. and Chinese companies, and affect American consumers. And that's your brief, John.
Hey, Danny, thank you. More from Danny later on this morning. Up next on the program, the president doubles down.
We've been treated very unfairly by Canada. We've been treated very unfairly by Mexico. But we've been treated very unfairly by every country all over the world. The European Union is horrible.
Do you think there will be a recession?
I don't see it at all. I think this country is going to boom.
Up next on the program, Adam Posen of the Petersen Institute, live from New York City this morning. Good morning. Equities bouncing back by 0.5% on the S&P 500. We have seen some changes, some downgrades. HSBC, spoke to them just moments ago, downgrading US stocks to neutral. Citi doing the same thing. Goldman cutting its S&P 500 forecast, the first big bank to do so. They dropped that from 6,500 to 62. Under surveillance this morning, we've got a president doubling down.
We've been treated very unfairly by Canada. We've been treated very unfairly by Mexico. But we've been treated very unfairly by every country all over the world. The European Union is horrible.
Do you think there will be a recession?
I don't see it at all. I think this country is going to boom. But as I said, I can do it the easy way or the hard way. The hard way to do it is exactly what I'm doing, but the results are going to be 20 times greater.
So here's the latest this morning. President Trump's 25% tariffs on steel and aluminum going into effect after he walked back a threat to double levies on Canada. Your team coverage starts right now with Bloomberg's Tyler Kendall in Washington, Divya Balji over in Toronto. Tyler, I think we have to take a step back and just think about the last 24 hours. Can you just summarize the tension between the Americans and the Canadians?
Yeah, good morning, John. This really caps off the latest on-again, off-again trade policy for this White House. And we should also mention that in those comments yesterday, President Trump went on to triple down that he is not watching the stock market in response to any of these tariff moves. Now, Commerce Secretary Howard Lutnick, Bloomberg News is reporting, led those negotiations with the Ontario Premier in order to have him drop that 25% electricity tax that was threatened and caused President Trump to say that he was going to up the tariffs on Canada today to 50%. Once those negotiations happened, the U.S. ended up dropping that tariff back down to the original 25% for Canada. Now, importantly, this will hit Canada particularly hard since it's the top exporter of steel and aluminum to the U.S. But, John, the White House confirming that there are no exemptions for any countries to the tariffs today. Domestic steel producers and aluminum producers have largely applauded this move, but we have to keep in mind that this does apply to those other downstream metal products like car bumpers and wires. And we have to be watching manufacturers closely here on whether or not they signal that they could up consumer prices. The auto sector in particular already sounding the alarm that the majority of their supply chains are concentrated in North America, and this could cause some severe disruptions.
Divya, let's bring you into the conversation. What's the status of this relationship right now? Has the president even gotten on the phone with the new PM, Mark Carney?
No, I mean, we definitely haven't heard of them having any conversations yet. I mean, I think if you think about Mark Carney, he does have a whole bunch of things going on, including the fact that there needs to be elections. But, you know, the fact that Trump is just talking about how terrible Canada is to the U.S. and all of these tariffs are still in place clearly shows you that the relationship is fraught in a sense. You know, you have seen a little bit of a better relationship with Ontario's premier, but with Carney itself, I think we are waiting for that conversation to happen, you know, just to see where will this go. Canada still has to add on a few more tariffs or a few more goods into the tariffs in about 2 weeks. Is that going to happen? I think there's still a lot of questions out there.
Divya, I appreciate the update alongside Tyler Kendall breaking things down in both DC and in Toronto. To extend the conversation, Adam Posen of the Petersen Institute joins us now. Adam, let's take a step back as well and just think about things. I know this is something you've pondered. The economic consequences of weaponizing uncertainty, what are they?
They're bad, John. The basic idea that President Trump came in with and was demonstrated with the tariff approach towards Canada and EU is that if you're the big bully on the block, you threaten people and you say, you don't know if I'm going to do this or not. And various people have said, oh, see, it's just a negotiating tactic. But it's not like negotiating with the Soviet Union in an arms race where you're dealing government to government with one other actor, and they can't afford to risk you're going to do nuclear weapons. In economics, you're dealing with billions of decision makers making hundreds of billions of decisions. So even if you're scaring the Canadian government, which you're not, then all kinds of people, businesses, investors, households react. And what you get instead is just this general miasma of uncertainty we've seen. Now, when I wrote about this last October, warning this was the core of the Trump International Economics Program on migration, on taxes, not just on trade. Some people said I was overdoing it. And I admit, in the forecast you and I have discussed before, I thought it wouldn't go this bad this quickly. But it was clearly the dynamic at work. And when you see the outsized chilling of investment, the outsized chilling of consumer spending and also the retaliations we're seeing from Canada and Europe, it's clear that this policy is backfiring.
Adam, is the uncertainty worse than the actual tariffs itself? Could the uncertainty push the United States into a recession?
It's a fair question, Annmarie, and I think both are really bad. But the uncertainty is the more immediate threat. And I do think the uncertainty could possibly push the U.S. into a recession. I think it's more likely that we'll come out of this with just a slowdown. The reason I'm being unsure is that the uncertainty does hold, and it does affect investment behavior, consumer behavior, the willingness of others to trade with us. But at the same time, there are things fundamentally resilient about the U.S. economy. And so if the uncertainty gets amped up because they do more aggressive actions on migration than deportation, or because the fiscal policy becomes very uncertain, or because they start talking about tariffs, as Kevin Hassett did, as a replacement for income tax, and thereby increasing the uncertainty about working people's incomes. All those channels could get you the recession in the U.S. It's always been if they overdid it on the tariffs, on the migration, on the fiscal policy, it would sow its own demise.
Adam, you've been out front saying that tariffs are inflationary, and a lot of people in markets have agreed with you. There has been a shift, though, where the emphasis is now on the recession potential or some sort of downshift in growth versus the inflation. We get CPI in a little more than 2 hours. How are you viewing this offset of inflation and slower growth, and which is to win out at a time where a lot of people are, frankly, based on market activity, confused?
Lisa, it's right for people to be confused. That's what uncertainty means, right? That there's legitimate reason to be confused. That's as opposed to risk, which shouldn't be confusing. In my view, I think that what's baked in is the inflation. That whether we get stagflation, meaning recessionary forces of the kind you're talking about, along with the inflation, or whether we continue to get growth along with inflation, I think the inflation comes either way. This is not just because of tariffs, although that's a big part of it. What you're seeing is a real income loss for American families, American households, and a real income loss for the vast majority of small businesses that rely on imported goods and imported inputs like Canadian energy or Canadian steel. And so when there's a real income loss, people try to adjust.
Yeah.
They have to. And so part of it is recession, they cut back, but part of it is they raise their prices, they demand higher wages. And the balance of those is affected by the monetary policy. And since we're in a period where the Fed was, as we've discussed previously, in my opinion, too loose, in which the economy had not gotten back down to a stable low level of inflation to the full extent, and in which we're at close to full employment, because we're still at 4% unemployment, that the risks of inflation accelerating are quite high. So I think you're going to get the worst of both worlds. You're going to get inflation either way, and if a recession comes through these policies, it's going to be stagflation, not pulling down prices.
Adam, you're in Washington, D.C. Just quickly, how much consensus among the people who you speak to behind closed doors is there that maybe the uncertainty has gotten away from itself?
Not enough. It's very evident, but there's a lot of pushback. There's a lot of people saying, relating to what Annmarie just said, that, well, in the end, we're going to have this wonderful outcome. I'm reminded of Brexit when the UK did something similar to itself, declaring a trade war on itself. And people kept saying, like Boris Johnson, there'll be sunny uplands. Well, investment in the UK has been flat, basically, for 6-7 years. I don't think we're going to get that in the US, but you're going to get something similar. But no, in Washington, there are ideologues, there are wishful thinkers, there are people who have self-interest and denial. That's why I'm glad to have the opportunity to talk with you, because the markets and the people who have money on the line have to make it clear this is a destructive policy.
I was happy to talk to you until you brought up Brexit. This is a Brexit-free zone. Adam Posen. Adam Posen at the Petersen Institute. Adam, it's good to see you, as always. We've tried to avoid that for the last few years, haven't we?
We did, although it's come up in other ways. Brexit.
There's plenty of other alternatives too. Coming up on the programme, Sheila Kahyaoglu of Jefferies. As weakening consumer demand weighs on the airline industry, some big changes in the past 24 hours. We'll get into them in just a moment. From New York, this is Bloomberg. So this is your bounce following 2 days of losses on the S&P 500. Futures positive by 0.55% on the S&P. On the Nasdaq 100 up by, let's call it 0.7. Yesterday briefly dropping into correction territory, down almost 10% from all-time highs now, down around 9. Said this yesterday, said this a few times over the past week. That record high in the middle of February, it's not even a month ago. Feels like a lifetime ago.
When you take a look at some of the valuation declines that we've seen there since then, 16%, more than that on some of the banks and the bank index. When you take a look at the NASDAQ, at the correction there, a question is, what is going to create, to Max Kettner's point, that cathartic moment? I just wonder how much we're looking at some potential for, true recessionary fears coming through. What happens if it is just sort of this grind lower in the face of uncertainty that does not resolve? And that, I think, is something a lot of people are grappling with.
We're heading towards 4 weeks of losses on the S&P, something we haven't done since August of last year. But there's a big difference between now and August. We saw it in the hard data in August. We saw unemployment starting to inflect higher. The Federal Reserve start to get nervous about things going into Jackson Hole when Chairman Powell delivered that speech. This isn't about policy. This is about policy uncertainty. And there is a difference between the two. This is about max uncertainty unnerving people.
And paralyzing companies, right? I mean, we've been talking about how companies have pulled back, individuals have pulled back. We saw that from the airlines yesterday, the idea that suddenly, on a dime, all of the appetite to really spend has shifted. There's a question about why. We've heard the same warnings from Walmart. We've heard the same warnings from Best Buy. At what point does this have a longer-term effect that shows up in the hard data? And when you talk about policy uncertainty, how does the Fed respond at a time where prices might be not going down anytime soon?
There's an extra wrinkle in this story. I want to turn to the bond market. So yesterday, the president doubling down on things with one of America's largest trade partners. And the bond market didn't offer comfort. Yields weren't dropping. Yields were all over the place. And I think this is what's really hard about this moment for financial markets, for allocators. The bond market's behaving in a really unpredictable way, day to day, depending on the stimulus. And you can have the same catalyst and you'll respond in different ways from day to day. And I think that's really problematic for a lot of people.
Yesterday, it was the JOLTS data, which is actually backward looking, and everybody poured cold water on it before. But the fact that the quits rate, an indicator of just how much mobility individuals think they have, the quits rate went up to a 6-month high. This indicates strength. If this is an otherwise strong market and you have an inflationary shock or a one-time price adjustment, as Scott Bessent would say, when it comes to tariffs, how much does that trickle in at a time where there are pressures, and we've seen this on Walmart, about how much they can pass along to ultimate consumers?
The 10-year this morning, let's call it 4.28. On our radar this morning, President Donald Trump downplaying recent market turmoil as tariff headlines whipsaw markets.
Markets are going to go up and they're going to go down.
Yeah.
But you know what? We have to rebuild our country. Our country has been stripped of its jobs, of its factories. Some people are going to make great deals by buying stocks and bonds and all the things they're buying. I think we're going to have an economy that's a real economy.
So let's take a beat on this because I think it's important. I think we understand the president's plans, and they've been articulated by Secretary Bessent pretty clearly. We've said this a few times on this programme. Lots of government on the border, tariffs, immigration, a lot less government inside the border, Doge, tax cuts. I think we all understand that. So if you want to rebalance the economy from the public sector to the private sector, pull back on government spending, acknowledge there will be some pain, some disruption in the near term, got it, we'll end up in a better place. That's the plan, that's the goal. Let's put that over here. Let's focus on tariffs. I said this moments ago. With tariffs, it's not the policy. I'm prepared to be incredibly open-minded about the consequences, how people respond to it, what's going to happen. Got it. But at the moment, we don't know what the policy actually is. It's the policy uncertainty that's problematic at the moment. If you give a business a headline, 10% tariffs, 15, 25, they'll work with that. As TK would always say, they'll adapt and adjust. If you tell them 1 minute it's 25, the next minute it's 50, then we've got a problem.
Especially because that increase to 50, is this the drug war? Are we responding to fentanyl now? Are we responding to retaliatory tariffs? Does this go into the bucket that we're supposed to learn about on April 2nd? Or is this the bucket that we heard about a couple of weeks ago? These are the types of paradigm uncertainty. It's not just a strategy uncertainty. It is a question of ultimately how you are going about really separating the U.S. economy from the rest of the world. What can Canada give us? Do we want to separate it entirely from our market? If that's the goal, it would be important to understand why that is helpful to the strength of the economy.
It doesn't sound like executives also left the business roundtable yesterday having certainty, understanding from the president exactly what the plan was going to be. You talk about Scott Bessent. He has said, the Treasury Secretary, Wall Street's done great. We're trying to move to Main Street. Well, guess what? When you look at mainstream press this morning, there's headlines like, what does this all mean for your 401k? This is starting to become a problem for the president with some of those individuals that are in his base politically.
If you're waking up this morning, you're waking up to more tariffs. We got the 25% tariffs on steel and aluminum. Also waking up to a response from the EU as well. The European Union retaliating, planning to impose duties on $28.3 billion worth of US goods. They've snapped back almost immediately, and they're set to continue doing the same thing in the next month or so.
April 1st and then the middle of April for a bit more of tariffs in retaliation to what the United States is doing. Something that really stuck out for me from the Europeans talking this morning. The EU is planning to hit beef and poultry from Republican-led states, Nebraska and Kansas, said one of
China
these officials.
playbook.
Exactly. Also, they're going to look at tariff retaliation to include House Speaker Mike Johnson's state. So that, what do you think when you think Louisiana? That's going to be a lot of agricultural. That's going to be energy. They're going to find other places potentially to send a message to the president. We will hit you where it hurts.
If you're worried about inflation, there could be a piece of good news out there, and it could be coming from Ukraine, accepting a US proposal for a 30-day ceasefire with Russia. In return, the Trump administration will lift the freeze on military aid and intelligence. If this administration can tackle this, if they can do something about the energy story, not just in America, but worldwide, because think about what's happened to the price of energy since this war started, then you've got a much, much better picture for energy, not just in America, but perhaps in Europe too. And then maybe you can paint a better picture for inflation as well.
This is a point that Treasury Secretary Scott Bessent has talked about extensively, that essentially the idea is to bring down energy prices and to generally reset trade. There's going to be a readjustment period or detox period, and then it will be okay. This also is interesting because it shifts the onus for the U.S. to now pressure Russia to really accept this deal. And now the real leverage has to come from how the U.S. goes about doing that when Russia really has not been as much a part of some of the contention in the past couple of days.
We'll bring you another update on that story a little bit later on this morning. Let's talk about some of the stock moves we've seen in the past 24 hours. Weakening consumer demand leading to a sell-off in airline stocks. Delta spooking investors after cutting its profit forecast in half. Sheila Kahyaoglu of Jefferies joins us now for more. Sheila, good morning.
Good morning.
Big changes. What did you see? What you were tracking in the last month or so? What's happened with these airlines?
We have a data series that tracks airline traffic on apps and folks pre-booking. So that data fell off about 10% over the last 3 months. So trailing 3 months, but the 3 weeks really fell off. It hit the lowest cost carriers the most. So back to Anne-Marie's point, it's in the heartland of where we're seeing the demand fall off. But Delta signaled a 50% revenue cut. They guided Q1 7 to 9%. Then they cut it to up 3 to 4. So still positive, as Ed Bastian said. We're not in recession territory, but January and February, which is the last time we heard from them about 3 weeks ago, was positive growth. And so that means the last 3 weeks really decelerated. So Q2 is going to be very important because it's about 40% of airline earnings.
As we strip out some of the motivating reasons for why we saw such a deceleration in demand, can you track the fall off in airline ticket purchases to some of the safety issues that were raised?
That was cited by both American and Delta yesterday, but it was across the board, and that's what I think startled so many folks. It was Delta close-in booking, so people book airfares closer to when they're actually going to travel. It was also corporate demand softened. We've seen that in BizJet utilization data as well for February. And then third, it was demand across government, which United has about 4% of ASMs and American has 1.5%. So it was across the board. It was Trump's policies, DOGE really impacting government employees, corporates slowing down, and then, just leisure demand slowing as well.
We heard from Delta that they plan to cut capacity to meet slower demand heading into the summer. What does that indicate to you about just how temporary this is, or if potentially some of the airlines are preparing for this fall off to continue for a longer period of time and hoping to increase prices to compensate for it?
I think domestically in the U.S. market, capacity is already very tight. That was the story of the first half of last year. Capacity grew 6 to 7%, and then we exited the year about flat. And the data, TSA volumes are flat year over year, but so is capacity. So capacity is already fairly tight. So that's a soft comment from Delta to make to cut capacity. We have to see demand come in, and I think the next 4 to 6 weeks is going to be very critical to see how the U.S. consumer is going to react.
Where does the demand come in? I think we were all struck around this table yesterday when a headline dropped that United said 50% drop in government travel. Who fills that void?
It's hard. I mean, it's a small percentage of ASMs, but then Delta also cited corporate demand across the board. Aerospace and defense was, of course, the sector cited, as well as leisure. So it wasn't only one thing, and I think that's what is, more concerning about the reads. But again, it's early, and so that could change. If the S&P goes up for the next 4 weeks, I'm sure people will start booking travel again. So it's all based on market sentiment.
What's more challenging, domestic travel right now or international?
Domestic is more challenging. Domestic has always been because you have low-cost carriers. And so they price down. You see tickets from Spirit, other low-cost carriers for very cheap. International is still very positive. And the good news is A350s and 787s are very slow on the deliveries. So we're not seeing a lot of capacity come into the market. In fact, that market's very constrained.
You suggested it's equity market dependent. I might suggest it's Doge dependent. If I'm a federal worker this year, I'm not travelling. If I've booked a vacation, I'm cancelling it. If you've got to raise a family at the moment and you're dependent on the federal government for your annual salary, I'd be very, very nervous about the rest of the year. How is that showing up in the numbers already?
It's a small percentage of the market, but I think Doge in general, the headlines covering defense stocks it's what's scariest. Some of the headlines they put out are not actually the reality of what they're cutting. So again, it's going back to the uncertainty of a big headline and the reality.
Talk to us about that. What are they actually cutting when it comes to defense?
It's interesting to me because I thought they would go after larger, more bureaucratic issues. But instead, they're going after IT services contractors, which the 6 public ones we cover comprise about 3 of the largest defense programs. So I thought they would eliminate more waste, but they seem to be cutting very quickly and very abruptly, so without any precision, which I think creates problems as well.
How much of the story is this? And I ask this because yesterday I saw some comments out there, like if government spending was the main pillar of support for the U.S. consumer, then we had a pretty weak consumer, aside from some of the stimulus that was really injected into the government. Can you talk about what we've seen in terms of consumer spending habits leading up to this and then in the aftermath, and just how connected to the federal spending it is versus the overall tone? I know it's hard to parse out, but it kind of gives a sense of where we're coming from.
I think it's the government employees. If you're a government employee, you're probably not traveling. But again, that's such a small percentage of the market. And some of the agencies we're cutting from, they've already had trouble recruiting. And we've just gone back to pre-pandemic levels 6 years later. So I think it's very problematic just cutting abruptly. And I do think the airline cuts go back to consumer sentiment on the overall market, as we've all seen our stock prices have.
What's your favorite name this morning?
I'm going to actually pitch Boeing. I really like Boeing. I think outside the tariff headlines, the macro, we haven't delivered a single plane in 6 years. The skyline is oversold. And I think investors have capitulated on just demand. They think we're going to see demand destruction because the market softened for the last 3 weeks. But I think everybody's still waiting for their plane and is not going to get out of line. So,
Sheila, I appreciate it.
Sure.
It's good to get up to speed with you. Thank you. Sheila Kahyaoglu there of Jefferies. Equity futures right now near session highs, up by 0.6% on the S&P. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The Department of Education is cutting its workforce by roughly half. The department said that it's cutting 1,950 staff positions, including more than 1,300 federal workers. It's the Trump administration's first step in dismantling the agency. Staff at the Fed met with Elon Musk's Doge team in January. A new court filing shows that staff cooperated and discussed access to federal payment systems. The meetings took place 2 weeks before Powell's testimony to the House Financial Services Committee in mid-February, where he said the Fed, quote, had no contact with Doge. Paris Saint-Germain beat Liverpool 4-1 in a penalty shootout to advance to the Champions League quarterfinals. PSG evened up the aggregate score with a goal in the 11th minute and kept Liverpool scoreless for the remainder of the match. They now join Barcelona, Bayern, and Inter Milan in the next round. And that's your brief, John.
Donnarumma, absolute beast. Danny, thank you. More from Danny a little bit later. Up next on the programme, President Trump back in the first buddy.
Because he's able to find billions and billions and billions of dollars of fraud and waste and all of the things. I mean, our country is going to be very strong very soon.
Dan Ives of Wedbush joins us next, live from New York. You're watching Bloomberg TV. So here's the bounce. Equity futures up by 0.6% on the S&P 500. In the bond market, just about unchanged. The 10-year 427.98. Under surveillance this morning, President Trump backing the first buddy.
Because he's able to find billions and billions and billions of dollars of fraud and waste and all of the things. I mean, our country is going to be very strong very soon because of a lot of the things that he's done and a lot of the things that I'm doing. And there's no better team, but there's no better for what we're doing. There's nobody like this, and he shouldn't be penalized.
So here's the latest this morning. President Donald Trump expressing confidence in Elon Musk, but investors souring on the CEO's Tesla stock. Shares of the EV maker giving back all of their post-election gains. Tesla bull Dan Ives of Wedbush writing, "We believe this is a moment of truth for Musk and Tesla. If he continues to head down the Doge path 110% and showing no attention to Tesla, then brand damage will become more pervasive." Dan joins us now for more. Dan, welcome to the programme, sir. This was not what you thought a number of months ago, so what changed?
Look, I mean, we've talked about autonomous, deregulatory. That was the bull case, and that continues to be, because autonomous is going to be the key for Tesla. But, John, no one, including us, expected that when you look at Trump, Musk would essentially be living in Mar-a-Lago, living at the White House, 110% in Doge. And this has been, I think, clock struck midnight. I mean, this is now at a point where it's a tipping point where Musk needs to focus back on Tesla. And that's why I say it's a moment of truth. We've been here before, but this is, I think, tipped the scales, and we're seeing it in the stock.
You're right to say we've been here before, because we have, Dan. We used to talk about this with regards to SpaceX, that he was leading loads of different companies. It wasn't a problem then. Why is it a problem now? What's happening at Tesla that says to you it's missing its boss?
Well, it's because of the brand. Because the last thing that you want is Tesla to become a political symbol, you know, viewed as Doge or Trump or whatever you want to say. And that we've already seen, whether it's demonstrations and some of the concerns and some of the protests that we've seen globally. Look, that could all fade. And that's still contained at this point. It's the best car, and in terms of best car selling last year in 2024, Model Y. The issue now is they have the biggest sort of technology innovation ahead when it comes to FSD, unsupervised Austin, a new model coming out in the summer. You know, what I ultimately believe is really the start of this whole robotics and autonomous future. But now you need Musk to lead. It's time to come home and start to focus back on Tesla. And that's been a huge issue here. Investors have given, you know, sort of some flexibility. But now it's hit a tipping point. I think you've seen it in the stock. Frustration's building.
You said it's time to come home, Dan, and we heard from Elon Musk saying that he's going to be with the Doge effort for at least another year, or about another year. Is that enough, or does that make you think that you need to downgrade your outlook?
Yeah, at least I'd be surprised if that happened. In other words, like, my view is that I think he's going to have to see the writing on the wall. We know, look, we've been here, but we've talked about this, whether it was SpaceX, whether it was Twitter. We go back to other issues, 2018, 19. I think he's going to start to get the message. Now, look, it could take some time, but I believe this is when he's going to have to start to balance his time. He could still be focused on Doge. You have to be CEO of Tesla at this point. And look, Trump buying a Tesla, I mean, it's not moving the needle. And to some extent, it actually have a negative impact relative to the political symbol. And I think that's the frustration here, you know, when it comes to Musk and Tesla.
Dan, less than a month ago, you said the best is yet to come. You said you think it's going to be a bet for the ages in terms of Musk on Trump. When it comes to autonomous, it's worth trillions of dollars. That continues to be the golden goose, and it's what they're focused on. You thought his proximity of power was going to unleash this epic demand for Tesla. What happened?
Well, look, I mean, medium and long term, it's that. In other words, autonomous is the future. I believe the federal autonomous roadmap will be there, and that ultimately all of this would actually just be noise relative to what could happen in terms of what that means. That's worth $1 trillion to the story. And that's why I think this is probably the biggest sort of physical AI play out there. But that said, this near-term situation is unsustainable. And I think no one expected that he would dive so into the deep end of the pool when it comes to Doge. That's where he's spending all of his time, always in Mar-a-Lago, always the White House. And I can tell you from Tesla shareholders, it's at a point where white flags up. He needs to change, needs to balance. Otherwise, everything we talked about, autonomous, bet for the ages, this negative, the brand issues, that then starts to actually taint some of the long-term impact. That's our concern here, and that's why, we're really communicating that to Tesla and the board.
Dan, I have to be honest. I don't think I've ever heard you this as unenthusiastic about a U.S. tech stock ever. I mean, next time we see you, you might be wearing a black suit. I'm just wondering, can you look back in your history of calls and ever felt this uncertain about a name that you were quite enthusiastic about just a couple months ago?
Oh, we did it with Tesla during the Twitter situation. We've done it with Tesla. If I go back 2018, 19, sometimes it's tough love, right? I mean, Tesla is probably one of the names we're most bullish on in all of tech. And I continue to believe, tech is way oversold. But you got to speak out, because when I talk to thousands of investors around the world, I need to communicate what I believe Musk needs to do now for that long-term story to play out. And that's what needs to happen. Silence just can't happen. You can't be glass half full. Given the situation, what's happening here with Doge and some of the brand issue and the worry about distractions and where he needs to be focused on his efforts.
Dan, to Lisa's point, you don't sound like a man with a 550 price target on a stock that trades at 230. So, Dan, what gets us to 550?
You get through this period, he starts to get more dialed than Tesla, and then, John, we're sitting there in the summer. That sort of golden case is there in terms of autonomous, FSD, unsupervised, and the long-term story. You got to get through this near-term turbulence to get to the gold at the end of the rainbow. Now's the time. It's a moment of truth. Musk needs to step up.
Just to understand your framework, if we get to the summer and nothing's changed, does your view change?
Look, if nothing changes from this on, then obviously brand issues would be a lot bigger, and that's something that could start to taint the story. I believe the longer term story continues to be this is going to be a $2-3 trillion market cap. But he needs to get through this period, because this is not serving anyone well. And I think that's really the message from Tesla shareholders.
Dan Ives of Wedbush. Dan, appreciate it. On Tesla, big drop-off in the past month, that's for sure. Big change for Tesla stock.
Big change for Tesla stock, and a lot of this has to do with the brand destruction and also the time he has spent at the White House. I mean, Dan is right in the sense that he is always by the president's side. You call him the first buddy, and there's a reason why. Laura Trump dubbed him that. He's at the White House, he's at Mar-a-Lago, and he said just to Fox News this week, with great difficulty he has running his companies.
What do you make of the outrage? The president with Tesla in front of the White House. No one did this with GM, Mary Barra.
It looked exactly like what Joe Biden did, and I was there on the lawn when he took that Hummer for a spin in August of 2021, and everyone was talking about, where's Tesla? Why'd you snub them?
If you have an outrage bucket, fill it with something else.
This is probably not the right one, right?
There are other things you can fill your outrage bucket with.
Honestly, what is it? Why can't we cover these stories objectively? If the president does it, President Trump does it, it's bad. President Biden, it's good, it's fine. There was no problem with GM and Mary Barra.
I actually think Trump bought the car, though. I don't think Joe Biden was shelling out to buy that.
Just giving free marketing to GM. That's the difference.
All right, okay.
Anyway, up next on the programme, Alicia Levine of BNY Wealth, Adam Hodge at Bully Pulpit International, Charles Schwab CEO Rick Wurster, and Lynlee Brown of EY. From New York, the second hour of Bloomberg Surveillance. Up next.
The market is in very much a show-me state, and the only way that you get there is clarity on inflation.
The consumer right now is tightening their belt a little bit.
There's still a good amount of spending and borrowing power.
The U.S. consumer market simply isn't driving the global economy bus.
The data's going to get worse, and inflation's not going to be as strong as they think.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now with equity futures positive by 0.7%. We've hardly talked about it so far this morning. The main event is 90 minutes from now. It's US CPI. US CPI a little bit later this morning. Really the last major data point going into the Federal Reserve next week. That decision a week today.
And it's taken on renewed importance as people are trying to figure out which they should weigh more, the idea of some recession fear or the idea of stagflation fear. It matters at a time where potentially the Fed could offset address some of the uncertainty with more certainty around their policy, but not if their hands are tied by hotter than expected inflation.
We're bouncing back this morning by 0.7% on the S&P 500. We have seen a series of downgrades, though, from Citi, from HSBC, and this morning from Goldman, dropping their price target on the S&P 500 from 6,500 to 62, and pointing to what most people are pointing to, policy uncertainty.
The uncertainty is what's hurting the market. I mean, if Trump comes out with maybe tariffs, but at least you know the direction of travel, that's one thing. But this uncertainty whipsawing within a day, a roller coaster of tariffs when it comes to aluminum. You know what Alcoa had to say? This is going to increase the price of things like beer cans for consumers. And that is the problem you have, especially on a day like CPI.
You're not going to get clarity anytime soon, because in early April, we do this in a much bigger way. The administration is telling you the big one comes in early April. This isn't it.
And it really is going to lead for more of the tit for tat that we're already seeing, where you get responses from, say, Europe or, say, from Canada. Going back to what David Kostin of Goldman Sachs was saying, and I think it's an important point, when you have uncertainty, you have greater implied volatility on a day-to-day basis, and we're seeing that in the VIX. And that alone means that you need to take some of the valuation off some risk assets, because volatility is a cost and you can't be as reliable. You can't rely as much on returns from those assets. And that, I think, is what people are increasingly trying to game out.
When it comes to April 2nd, a lot of analysts have come on this program and said that's going to be peak uncertainty. But April 2nd, we might just get the announcements, and then it could be 3, 4, 5, 6 months before the tariffs actually come into play, which means we can be dealing with this paralysis and uncertainty for months. This stuck out to me today from the Wall Street Journal. The president's economic advisors have warned him that tariffs could hurt the market and economic growth, but he has largely been undeterred.
2 months ago, what did we call it? The golden age of volatility. And that's what we've seen over the last few months, that's for sure. Session highs on the S&P 500. We'll see if it sticks. We're higher by 0.75%. Coming up this hour, we'll catch up with Alicia Levine of BNY Wealth ahead of fresh US inflation data. Adam Hodge of Bully Pulpit International as new tariffs take effect. And the Charles Schwab CEO, Rick Wurster, following Trump's meeting with business leaders. We begin this hour with stocks looking to snap a 2-day losing streak as traders await US CPI at 8:30 Eastern Time. Alicia Levine of BNY Wealth writing, equity market is pricing in the extreme of policy and a worst-case scenario. We think the growth scare, for now, remains a scare and is consistent with a soft patch. Alicia joins us for more. Alicia, good morning.
Good morning.
Good to see you. What would you suggest people do then, given the correction we've seen?
So I think we saw it a little bit yesterday when the S&P hit that kind of down 10% correction mark. You saw buyers come into the market here because for the most part, if there's no recession, a market down 10% tends to have pretty positive returns in the 12-month forward. And so I think that's part of why we saw the market rally towards the end of the day, because it was sort of a magic point in the market. And when markets come down this quickly, it's been so fast. No time to breathe here. You're ripe for a bounce, at least. And so I think that's part of what we saw yesterday.
Can you point to the dominant driver? There are some people out there who are suggesting this is not just about tariffs, this is something else. Because we are seeing big moves in things like Palantir, things that aren't really associated, typically what you'd consider to be associated with tariffs. What do you think of the overall price action?
So I think there's a couple of things going on. I mean, the really interesting observation here is if this were only about tariffs and the impact on growth and inflation, kind of a stagflationary mix that you've been talking about, we wouldn't see Europe outperform, we wouldn't see Mexico outperform, and we wouldn't see Canada outperform. Because in the end, it's the trade deficit that the U.S. has with our trading partners that would make the U.S. more immune to the impact of tariffs than our trade partners. And yet those markets have outperformed. So clearly there's something else going on. It's not simply about fear of tariffs in the cross-asset trade. There is a momentum unwind here. You know, the multiple was high, not terribly high, but high enough to unwind. And as you know, we talk about this all the time. The markets live in the second derivative. So if the U.S. performance or earnings are slightly worse than expected and Europe is slightly better, that's enough to have Europe outperform in a world for 15 years. It's underperformed, is trading at lower multiples, and seems like a more interesting place to park some capital right now as the U.S. sorts out all of its issues right now as we kind of have a bit of a regime shift in administrations.
Momentum unwind sounds a lot more palatable than just peak uncertainty that isn't going to resolve and that could potentially slow growth in a significant way. How can you tell if it's just a momentum unwind versus something more entrenched that will have real economic consequences down the line?
So I think if this were only about the fear of a growth slowdown, you wouldn't see the rest of the world doing so well because, as you know, when the U.S. catches a cold, the rest of the world has the flu. So what you're seeing it in the cross-asset trade telling you this is a bit of valuation unwind, perhaps the semis and the tech trade. DeepSeek, I think, was a large break. And that's the beginning, really, of where you saw all of this really start coming undone. That was really early January. It was in mid-February with the rest of the market. Those stocks have really been on a slow leak downward since the DeepSeek announcement. So this is more than just a growth scare. And on the other side, like on the bond market, yes, the bond market is priced in more of a slowdown with 3.5 cuts expected this year, but you're not seeing the 2-year collapse. So there's something more going on here, right? It's a soft patch, it's a slowdown, and there's some reversion to the mean in other equity markets. We have our clients say to me, for the last few years, why are we diversified? Why do we own bonds? Why do we own the rest of the world? Why am I just not piled into the U.S. equities? And we say there'll be a day where you'll recognize the power of diversification to smooth out your returns. And we are in that day.
I love this. You're calling up your clients and saying, guess what? It's now. So thank you very much. You're welcome. And here's your returns. There's a question, though, that we heard from David Kostin of Goldman Sachs, which is the degree of uncertainty requires a higher risk premium just naturally. If you don't have the same kind of risk-adjusted return, then you have to account for that. How do you weigh that in?
So I think that's right. So, we think that there's definitely a soft patch here. And the question is whether all this market turmoil helps push it into something more, right? Because what we've known is that the wealth effect, the $50 trillion that households have accumulated in the last 5 years since the beginning of COVID has really helped cushion spending. If you take an axe to that, meaning the market sells off, then do you create a negative wealth effect and do you dent the consumer? That's really the question here. So, yes, there is some risk premium that you have to think about. Again, we get at this through the diversification. Bonds are really getting to work this year as ballast to portfolios. But I think the observation is correct. Earnings probably have to come down, and the multiple has to come down. Even with earnings estimates coming down, the multiple now has come down from 22 times forward to 20 times. So that's already looking better. You're getting to a place where it's more interesting to put your toe back into U.S. assets. In the end, if you're going to bet on growth for the next few years, is it European growth? Or is it U.S. growth? And that's the question we ask ourselves every day.
So you don't think U.S. exceptionalism is dead?
I don't think it's dead. I think it's taking the pause that refreshes. The question is, how long is the pause? This concept of short-term pain for long-term gain. I like to say, well, the long-term is made up of a lot of short-terms, and none of this is linear. So the longer this goes on with tariffs here, tariffs there, well, we're going to take it back, that can have its own negative feedback loop. For now, we think the scare is precisely that, but are open to the thought that it might unwind further.
There's a line in your notes that I love. Market is trying to force a policy response from the Fed or the White House. Do you think they do it?
So I think you're starting to see it a little bit on the Fed side. I'm just going to say that, right? We've got a week from today. The White House is trying to signal, and I think they're using the market to signal that they're serious, and that's also a negotiating tactic.
Do you think this White House is trying to engineer a Fed cut?
I think they're trying to get the 10-year down. I'm taking the words of the Treasury Secretary very seriously. He said it on your program, February 6th. We're focused on the 10-year. That was the signal to the market. I take it very seriously. I think the whole market does.
He said it repeatedly. I want to finish on this. We mentioned US CPI. Haven't talked about it again. How relevant is that data point?
Oh,
late 30?
Terribly relevant. Terribly relevant, because it either reaffirms the concerns about a stagflation rate or it doesn't. And so I think you're going to see volatility around it. If it comes in even slightly better than expected on the 100th decimal point, market could have a massive rally here.
Alicia,
look at the put buying. The put buying is off the charts.
Stretched. It's a word I've heard a lot in the last 24 hours. Alicia Levine there of BNY Wealth. Look out for US CPI, 1 hour and 20 minutes from now. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Another downgrade to U.S. stocks. Goldman has cut his S&P 500 year-end target to 6,200 from 6,500 and said that the Magnificent Seven have become the Maleficent Seven. The bank cited lower GDP growth, higher tariff rates, and a higher level of uncertainty. Goldman also lifted its view on European earnings. Ukraine has accepted a U.S. proposal for a 30-day truce with Russia in exchange for aid and intelligence. That followed 8 hours of talks in Saudi Arabia on Tuesday. The deal includes prisoner swaps and Ukraine mineral development. The U.S. will now seek agreement from Russia's President Vladimir Putin. Elsewhere, Uber has terminated its deal to acquire Delivery Hero's Food Panda business in Taiwan after the island's antitrust regulator rejected it in December. Uber is required to pay a termination fee estimated to be about $250 million and will not pursue an appeal. That's your Bloomberg Brief. John.
Danny, thank you. More from Danny later on this hour. Up next on the program, doubling down on tariffs.
The president is unwavering in his commitment to restore American manufacturing and global dominance, and I think he doubled down on that with his new statement and the tariffs that will be implemented on steel and aluminum.
Following through on those tariffs overnight, 25% on steel and aluminum. Reaction from Adam Hodge of Pulpit International from New York City. Good morning. Tariffs go on and the sun still comes up in the morning. The world doesn't end. What a beautiful morning here in New York City. Good morning to you all. Equity futures right now on the S&P 500 positive by 0.8%. Under surveillance this morning, doubling down on tariffs.
The president is unwavering in his commitment to restore American manufacturing and global dominance, and I think he doubled down on that with his new statement and the tariffs that will be implemented on steel and aluminum.
So here's the latest this morning. President Trump's 25% tariffs on steel and aluminum taking effect, and the EU is fighting back.
The U.S. administration has opted to pursue a harmful course of unjustified tariffs, leaving us with no choice but to respond, and that's exactly what we are doing.
Joining us now from the nation's capital, Bloomberg's Tyler Kendall from Washington, D.C. Tyler, welcome back. How does this set us up for April 2nd going into next month?
Exactly, John. This White House has often brushed aside retaliation, saying that ultimately it will just get factored into those April 2nd reciprocal tariff calculations. We're going to have to see, though, how long that defense lasts, because while we are still waiting on that final list from the European Union, we are expecting up to $28 billion worth of U.S. goods to be tariffed. And importantly, a senior EU official telling Bloomberg News that the EU is going to target some politically sensitive items in some Republican states like soybeans in Louisiana. Of course, that's home to House Speaker Mike Johnson. It continues actually a recent trend that we've seen, such as from China, for example, this week, announcing that they too are going to retaliate with tariffs against U.S. agricultural products. And if the pile-on keeps coming for U.S. ag, that really could prove to be a pressure point for Republicans in Congress who have long been queasy about the potential impacts there could be for farmers. For example, just quickly, one statistic I pulled, the U.S. agriculture industry lost $26 billion between 2018 and 2019 during the height of President Trump's tariffs under his first term. At the time, the USDA gave payouts to farmers, but this time that might be a little more politically difficult, considering that this U.S. government has spoken a lot about pulling back on government spending. So we'll have to see how negotiations go from here. John, one EU member state will be at the White House today. President Trump is set to meet with the leader of Ireland.
And they have a massive trade deficit when it comes to the United States, actually the biggest when it comes to the EU. So I'm sure we'll hear about that with President Trump. But when it comes to this week, what can we expect on the trade front before April 2nd? Because we do know that Canada is sending some officials to Washington.
Right, and we're going to have to see where negotiations go from here, particularly as the rhetoric with Canada continues to heighten. Here we saw those on-again, off-again plans just yesterday, with President Trump taking to Truth Social to threaten that today's tariffs could have hit up to 50%. But this White House really doubling down that this is about a long-term impact here, that they want to sustain longer-term growth, and they appear to be asking consumers as well as investors to remain patient. But it has spurred some recent reporting from Bloomberg News indicating that this is pushing the White House and Congress to try to get President Trump's tax agenda off the ground a little quicker, try to get some more cash into consumers' pockets as quick as possible as they try to counteract what has been this response to their tariff plans. That means setting up later this week when we are talking about the negotiations on the tariff front, whether or not any exemptions could come out. We also are going to see side-by-side negotiations as they try to push Republicans on Capitol Hill to get moving on implementing that broader fiscal agenda.
Tyler Kendall with the latest down in Washington, D.C. To build on that conversation, joining us now is Adam Hodge of Pulpit International. Adam, welcome back to the programme, sir. I want you to help us understand this. The president says he's focused on the long game, wants to get away from short-termism. He doesn't have to run for election again. There are members of Congress that will have to do that in the next 18 months or so when they face down the midterms and have to start campaigning. What is Congress going to do between now and then?
I think there are a couple big things on the horizon, including the tax bill that you guys have talked about. But I think the point that you've already seen what Democrats have tried to do is make the Republicans in the House own this. Like just yesterday on the budget bill, they put together one of the amendments that would have forced all the Republicans to take a vote on the wisdom of the tariffs. That is really making the pain acute for all the members of Congress. And I think it's something that you're going to see Democrats try to do to force that issue onto the agenda for the midterms over the next few months. I think the uncertainty in the markets, though, is the thing that I think is driving a lot of the agita in Washington. And so we're going to see how much that tail wags the dog over the next few months.
Adam, when it comes to the Democratic pushback, are they struggling because Biden did keep some of Trump's tariffs on when he was in office?
I think there's a really key distinction there. The tariffs that we put in place during the Biden administration were coupled with huge investments to try to increase American competitiveness. And what you've seen so far from DOGE and the Trump administration is a pullback of a lot of that investment. And so it's created uncertainty for folks in, certainly on the infrastructure side, folks in the clean energy space, people who were counting on major investments in batteries and with a lot of foreign partners investing in that space as well. So I think that is clearly where Democrats, I think, have to try to find a way to articulate a smarter message that it is a yes and proposition. It is, yes, we can be strategic about the tariffs, but we also have to couple that with smart investments that power economic growth. The pullback is really what I think Democrats have an opportunity to harp on over the next few months.
From a sequencing perspective, you worked at USTR under the Biden administration. When Trump says April 2nd, we're going to get tariffs, how do you read that? Do we actually get tariffs, or is there going to be months of public commentary that everyone needs to basically listen to before they come into play?
Annmarie, you're absolutely right. I think there will be an initial announcement that we're going to be a process, and then folks will have a chance to weigh in, public comment, and then at some point down the road, you're going to get an announcement on tariffs. But that uncertainty really, again, is a thing that weighs on businesses and weighs on the markets. But I think the steel and aluminum trade is particularly important because you've seen companies and businesses try to get around it, right? I did a little bit of homework for you guys. The Commerce Department in January said that steel imports increased 43.5% in January. So you've already seen businesses try to get ahead of what they think the tariffs could be. And I think over the course of the next few months, you're going to see even more of that as they try to get ahead of whatever uncertainty could come from the Trump administration.
There's a real challenge right now, Adam, for the Democrats, especially after the continuing resolution was passed by House Republicans, where they have to decide whether or not they are going to be the obstacle that potentially leads to a government shutdown next week if they don't allow it to get through the Senate. How do they tackle that in a way that doesn't shut down the government?
Well, I think it's important to remember the Republicans have control of the House, the Senate, and the White House. They control the government, right? So this idea that Democrats are somehow responsible for shutting down the government, I think just doesn't really pass the smell test. And you've already seen in some polling that 20% margin, people are more likely to blame Republicans for a shutdown than Democrats. I think what you've seen the Democrats also focus on are the really painful cuts that the Republicans have put in the bill. Things that are overwhelmingly popular, things like nutrition assistance, things like clean water programs, things like veterans benefits. That is, I think, where you've seen the Democrats try to focus the agenda and focus the conversation on what those cuts mean to everybody. But I think the bottom line here is that all of the Republican budget plan locks in some of the DOGE process, which has so poisoned the well with Democrats and in Washington. And so I think you're going to see a really united front for Democrats. And if the government shuts down, it wouldn't surprise me. And I think Republicans will end up shouldering most of the blame on that issue.
I guess what I'm getting at, Peggy Noonan wrote an op-ed in the Wall Street Journal a couple of days ago where she was saying that for a robust democracy, it's important to have strong parties on both sides. And what she's worried about is she's not seeing it at all from the Democrats, and that she's concerned that they're not really pulling it together to present an opposing message. And instead, there's sort of a lack of a leader, and there's a lack of, well, certain parts of this make sense, but these are the parts of the methods that we don't agree with. Are you seeing any kind of coalescing around that type of message from the opposite party at a time where people are concerned about some of what you just put out there?
Lisa, I think that's a really smart point. And I think the thing to keep in mind is like this budget fight this week is just a preview for the main event later this year on the tax cuts. And I think that is where Democrats have already clearly honed a message around Medicaid cuts and the potential tax cuts for billionaires and the wealthy and corporations. That they feel is a very strong argument for the midterms and throughout the next couple of months. And it really coalesces around two very simple ideas: Medicaid cuts and tax cuts. That is something that I think they feel very strongly about, a strong contrast with President Trump and the Republicans on the Hill. That is where I think they can speak to working class voters. And that the key, though, is to very, very disciplined and focused on those issues. That's going to be the whole ball game. And so we're going to see that play out over the next few months. And the tariffs will be part of the backdrop. But I think that the real key for this year is the budget fight.
Adam, can you give us the Democratic perspective on how they're managing things right now with regards to DOGE? What do you think about the messaging regarding that? Do you think they're doing the right thing?
I mean, just look at the real dent in Elon Musk's popularity. Right? I mean, think about the dent in support for President Trump's economic policies. Those are all down from the beginning of the year. So there's been some progress, but I think, again, nobody in Democrats have to be careful here. You don't want to root for failure. Nobody wants the U.S. economy to go into a recession. That's bad for Democrats. It's bad for Republicans. It's bad for the global economy. So you have to focus on what are the key issues that resonate with working people, and what's your plan? What's your ideas?
Well, one key issue, just to jump in, Adam, because we're against the clock, forgive me. One key issue might be just to agree that sending thousands of dollars to put on dance classes in Wuhan, China might not be a good use of taxpayer money. Start there and then say, we'll do things better.
Well, but I think what you've actually heard Democrats focus on are the cuts to nuclear bomb specialists or air traffic controllers or veterans. Like, those are a much more politically saleable point that Democrats can focus on. Like, there's no question there's waste and fraud and abuse in the government. The question is, are you have a strategic approach to really shrinking the size of government? And so far, you've not seen any strategic process so far.
Adam, appreciate your time, sir. As always,
good to be with you.
Your opinion. Thank you very much. Adam Hodge there of Bully Pulpit International with the Democratic perspective on a range of initiatives down in Washington, D.C.
A question of if your enemy is making a mistake, do you just let them, do you stand back, or do you present some sort of counter message at a time where that might not be enough?
Equities right now, session highs up by 0.8% on the S&P. Up next, we'll catch up with the Charles Schwab CEO, Rick Wurster from New York City. This is Bloomberg. Two sessions into the week, we're heading towards 4 weeks of losses on the S&P, something we haven't done since last August. Equity futures at the moment just about positive by 0.8%. On the Nasdaq 100 up by 1 full percentage point. Later on this morning, 1 hour from now, 8:30 Eastern Time, US CPI. With 2 hours until that cash open, let's get you some morning movers. We can do that with Yahara Hackers. Hey, Yahara.
Hi, John. We start with Intel getting a pop here in the pre-market, up nearly 8% after Reuters reported that TSMC has approached NVIDIA, AMD, and Broadcom about a joint venture to operate Intel's foundries. Under the arrangement, TSMC would own no more than 50% of the business. And the reason that is important is it aligns with U.S. interests to revitalize Intel without handing over full ownership to a foreign entity. Next up, we have Walmart. Those shares are now up slightly, paring their losses from earlier after the retailer got blowback from China for reportedly asking suppliers in the country to reduce prices to offset the cost of tariffs. That way, Americans would not have to pay more for their products coming in from China. So in response, Chinese authorities summoned Walmart executives saying that is not okay. And I know you'll have more details on that a little bit later. And we end on a high note with Groupon shares soaring here, up 20%. They give an outlook that beat analyst estimates. But what I find interesting is what it says about the consumer. This is an online coupon company focusing on services and experiences. So at a time when the consumer seems to be on shaky ground, Groupon may stand to benefit. John?
Yahara, thank you. That name up by 20% in the pre-market. On our radar this morning, President Donald Trump downplaying the recent market sell-off, saying he does not foresee the U.S. going into recession.
Do you think there will be a recession?
I don't see it at all. I think this country is going to boom. But as I said, I can do it the easy way or the hard way. The hard way to do it is exactly what I'm doing, but the results are going to be 20 times greater.
Everybody's trying to get him on this question. What do you think of the market action? Do you think we face a recession? On the markets, he's not biting. Stocks go up, stocks go down. He is not interested right now at all.
And the message is being heard loud and clear that to the extent that in the first term he was regulated by stocks going down, this time around, at least they're going to have to go down a whole lot more to get his attention. And I think that's one reason why people are saying likely this uncertainty is the new normalcy. And that's something a lot of people are trying to work into their analyses.
If you look at what this administration wants to see go down, it's rates and it's energy. And on that front, they're actually doing a pretty good job. The issue with the stock market, I think, really is it's going to start to bite him when it keeps coming up in places like USA Today, front page, what do you do with your 401k money? This is going to hit his MAGA base, and that's really the problem.
Still got to figure out the consequences of all these tariffs as well. It's very difficult to understand how the costs will be distributed, how certain countries will respond. Here's an example of that. Chinese authorities summoning Walmart executives after the company reportedly asked suppliers for price cuts to offset tariff costs. A social media post from Chinese state media warning the demands risk fracturing the global supply chain. So the administration says the exporters will eat it. Walmart tries to get the exporters to eat it. China steps in.
They slap their hands. They say, really, you're going to have your Sam's Club and really drum up a lot of business here in China, and you're going to make all these products. Well, we can play ball, too. And this highlights how it's going to be really difficult for companies simply to say to the countries that are getting tariffed by the U.S., OK, you eat this. And they're like, no, thanks. Here, take it back. So then it goes back to this question of how much can they raise prices for consumers that have already demonstrated a general weakening trend. And they're going to have to deal with that.
Clearly, this shows that Walmart is struggling potentially when it comes to tariffs, and they're going to have to pass it on to consumers. So they thought maybe we could get China to take on some of that. I wonder how much this is the Chinese officials getting a message to Washington via Arkansas and saying, we're going to call in your CEOs and we are not doing this. This is your president. You guys handle it.
It's the red state play that apparently the EU is going to play the same playbook in the next month or so.
Exactly. They're going after states that have agriculture, that have energy. Louisiana, they deliberately are talking about going after the Speaker of the House's state to get a message to Donald Trump about these tariffs.
Let's talk about the latest in Congress. House Republicans passing legislation to keep the U.S. government open past this weekend's shutdown deadline. The bill will likely need support from at least 8 Democrats in the Senate to become law.
As Jake Sherman says this morning in Punch Bowl, 8 Democrats are going to have to walk that plank. They had this lunch yesterday, and the prevailing belief, he says, after this meeting was that a shutdown would be lose-lose situation for Democrats. They don't want to be seen as they're signing up for Trump's continuing resolution to keep the government open. But is it potentially even worse to be the party that then shuts down the government, especially as you're trying to go after DOJ for what they say causing havoc across agencies?
Given the headlines we've got elsewhere, I don't even want to talk about the potential of a government shutdown. Equities right now, session highs up by 0.9%. Let's turn to investor sentiment. The team at Charles Schwab writing, with 44 million client accounts, we have our pulse on how America's investors feel about markets right now. We've seen increased engagement and outreach from retail and institutional clients. I'm pleased to say that joining us around the table here in New York, Rick Wurster, the President and CEO of Charles Schwab. Rick, it's good to see you, sir.
Jonathan, thanks for having me in.
Approaching 100 days in the job, have you slept?
It's been a busy period. We've been actively supporting our clients and helping them get to where they need to be in their financial life. So probably not as much sleep as I would like.
I'm sure you're probably not going to catch up on sleep anytime soon, given the headlines we've got elsewhere. Looking at those 44 million client accounts, just help us understand what activities look like, how they're responding to all of this incoming information.
Our clients are actively engaged. Last year we did about 6 million trades a day on average. In January we did 7 million. We're doing even more the last 6 weeks. So our clients are engaged. We're not seeing any signs of significant nervousness. In fact, we've seen our margin levels over the last month stay relatively flat. Those with margin have been leaning into equities the last week. You know, I went and visited 5 of our retail branches in North Carolina yesterday, and I walked into our Raleigh branch and met Gloria, who's at our front desk, and I asked her, Gloria, what are clients saying when they come in our doors? Are they nervous? And she said, you know what, we've had a couple that are nervous, but more than anything, they're bringing in checks, and they want to get more money into the market. So I thought that was a good sign.
This is fascinating, and it really skews with some of what we're hearing from Wall Street analysts who are saying we're just looking for the right levels to buy the dip. And it sounds like retail investors have been conditioned in the same way. At what point are you going to get worried that maybe they're being conditioned in the wrong way, say, if there isn't that bounce that we've become used to?
Well, in the 70s, Chuck wrote our investing principles, and they're all about taking a long-term view of markets, being diversified, having a plan and sticking with that plan. And I think when markets go up, when markets go down, those are the principles we come back to. It's hard to have a view on short term what's going to happen on markets, but those investing principles we think work. And you're seeing it this year where a diversified portfolio, European stocks are doing well, gold's doing well. There's assets that are performing well. So our clients that have taken that advice are hanging in there.
So retail investors are often painted with a brush where they buy Bitcoin and Tesla and AMC and GameStop, and then they hold their breath and keep buying when things go down. What is the picture of the retail client of Charles Schwab that you're going after?
Well, we see 7 million plus trades a day. We see more than 2 times the trades of any other retail brokerage. So we do feel like we have a pulse on how retail investors trade. And I think they trade very thoughtfully. We've got a range of investors, some of who are buying Tesla, who have been invested in Bitcoin and made a lot of money doing so. But we also have a lot of investors that play for the long term. But I think, you know, our investors are really thoughtful. They're engaged. They listen to your show. They listen to Lizanne and Jeff Kleintop and our thoughtful analysts. They're trying to make the right long-term decision for them and their financial plan.
I'm getting the sense from you that your investors are not concerned about the uncertainty emanating from Washington, D.C.
I think, again, we try to coach our investors to take a long-term view. I'm sure we have clients that are nervous about whatever the policy of the day may be or the news flow of the day. But in large part, one of the great things about Schwab is we have a lot of different ways to engage clients. We've spoken with over 600,000 clients in the last week. We're able to remind them that they have a plan, that these are the times to stick to their plan, and we try to remove them from the news cycle.
So this is talking to you as a market participant. Let's talk to you as a business leader. You've got to run a company. Right. We're hearing from a lot of companies right now that they're just hitting pause and they're waiting to get clarity on policy. I imagine you're not hitting pause. Can you walk us through what your plan looks like through the next several years?
We're not hitting pause at all. 2025 is a liftoff year for our company. We've spent the last couple of years integrating Ameritrade into Schwab, and now we have the benefit of having the best of everything that Schwab has and the best of everything Ameritrade has for our clients. So the future is all about growth, and we are seeing our growth accelerating through the first quarter. We've seen significant levels of client engagement. So it's for us, from a business standpoint, we are thriving.
So you're not cutting down on travel and forcing everyone to come back to the office and saying, guys, it's time to tighten the ship?
We've not taken any of those actions.
Okay. The reason why we ask is we were wondering how much this is trickling out, although it could be a somewhat counter-cyclical business. As you go forward, when you are expanding, who are you going after at a time where a lot of the big private asset firms are trying to broaden out into private markets for retail clients? And that's the increasing holy grail for a lot of the big banks as well. Who are you going after? Who's your competitor?
Well, in terms of who we're working with, we work with clients across all age and wealth spectrums and advisors of all sizes. You know, we have 1 out of every 6 American households with more than $20 million in our country works with Charles Schwab. And at the same time, we're crushing it with young investors. 60% of our new investors last year were under the age of 40, and a third were under the age of 30. So we are really thriving across age and wealth spectrums. There is a lot of demand for alternative assets, and we're working with great firms like KKR and others that are bringing their capabilities to the retail investor. And I think that's a great thing. Historically, that's been for institutions only, and now we can bring it to our retail clients.
Are other business leaders who you talk to as confident and as excited as you are?
Well, their business has their own dynamics. For us, we're in a liftoff
Hold
here.
on a second.
We're doing
the
well.
The reason why I'm asking is because we've been talking about uncertainty and we're seeing it in the data, whether it's small business confidence, whether it's business confidence more broadly. Are you saying you just don't see it, or are you saying that your business is somewhat immune to it?
We feel like we have an all-weather business model. The news flow, for us, that drives activity and engagement, and it brings investors into the market. And we've had 7-8 million trades a day, which is a lot for our business and drives our economics. So, the market engagement is a good thing for us. At the end of the day, what's most important to us, though, is that our clients are doing well. And that's where we put our energy into making sure we can help them in the channel of their choice get to where they want to be in their financial life. That's what drives us. When our clients do well, we do well.
Rick, what's it like working with the president? Because you are advising them on this offspin of this Trump-linked truth-fi associated with Trump media.
Well, we've worked with administrations and regulators for 50 years, and we've tried to work with clients across all aisles. We are supportive of our country. We are Americans. We support 44 million American client accounts, and we want investors of all types to do well.
Well, the financial services industry might have a new regulator, and this is the name we've got for you. According to a person familiar with the matter, the Trump administration will nominate Federal Reserve Governor Mickey Bowman as vice chair for supervision as soon as today. You will recall that Michael Barr, of course, resigned earlier on this year as the Fed vice chair for supervision. Mickey Bowman, of course, nominated by President Trump in his first term to become a governor of the Federal Reserve. A lot of people not seeing this as a surprise, I imagine, this morning. This was a name we had in the hat, not just for this role, but also for the Fed chair role that might open up further down the road.
Right, and this is someone that Trump administration has looked kindly on, first people to put her there in the chair. So this really isn't a surprise, but it is interesting. We are getting some clarity as we keep talking about uncertainty coming out of Washington. This is one place where we do have a name and some clarification.
It also means that she's not going to be nominated to be potentially Fed chair, which opens up the seat to potentially somebody else who seems to maybe want to be Fed chair.
Rick, a final word on regulation. Have you got everything you want?
I think Governor Bowman's going to be a great choice. I've met with her personally. I think she's a very thoughtful person. It's going to be great for the great for supervision.
I imagine a lot of people might agree with you. Rick, it's good to see you, sir. Thanks for breaking things down for us. Appreciate the update.
Thanks for having me on.
And thanks for being a good friend of this programme over the years too. We appreciate it. Rick Wurster there, the Charles Schwab CEO. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The Houthi militant group in Yemen said that it would resume attacks on Israeli ships for the first time in about 2 months, demanding the country end a ban on aid entering Gaza. It will likely deter container ships and tankers from sailing through the Suez Canal and southern Red Sea and may lead to a rise in global freight rates. Greenland voters unexpectedly picked a party that backs a slower approach to independence from Denmark. The vote took place in the shadow of President Trump's expressed desire to take over the island. Both popular parties campaigned on independence from Denmark and distancing themselves from Trump. Porsche shares are trading lower in the German trade by 4.7%. It cut its medium-term profit target. Porsche is struggling with declining sales in China and lower demand for EVs in Europe. Porsche will start an extensive rescaling this year, investing in models, software, and batteries, which will impact this year's financial results. That's your Bloomberg Brief. John.
Danny, thank you. More from Danny in the next hour, about 30 minutes away. Up next on the programme, a tremendously positive impact.
Hundreds of billions of dollars is being invested. That wouldn't have happened if I didn't win the election, number one. And I think, number two, the tariffs are having a tremendously positive impact.
The president sitting down with a business roundtable. We'll get a view on that with Lynlee Brown of EY. She joins us next from New York. This is Bloomberg. Equity futures on the S&P 500 up by 0.8% on the S&P. We've got more tariffs, 25% on steel and aluminum. Under surveillance this morning, a tremendously positive impact.
Hundreds of billions of dollars is being invested. That wouldn't have happened if I didn't win the election, number one. And I think, number two, the tariffs are having a tremendously positive impact. We have car companies that are not building in Mexico now. They're building in the United States. They don't want to pay 25% or whatever it may be. It may go up higher. Maybe go up higher. Look, the higher it goes, the more likely it is they're going to build.
So here's the latest this morning. President Donald Trump highlighting the positive impact of his tariffs just as Kohl's and Dick's join a list of companies raising concerns about the health of the U.S. consumer. Target, Best Buy, Macy's, all warning they may have to raise prices to deal with the levies. Lynlee Brown of EY joins us now for more. Lynlee, welcome to the programme. The number one question that market participants have at the moment, when will we get clarity on this situation? When can we move beyond peak uncertainty? When do you think we can?
That is such a great question. I mean, I think the hope is maybe early April when we get the administration reports about, unfair reciprocal sort of trade acts. I think maybe early April we get some clarity on the roadmap and maybe less of a ping pong match.
You write something very interesting in your note, which is that history tells us that potentially, besides China, the tariffs might only be in place for a few weeks. Do you take Trump 2.0 as in full-on negotiating mode when it comes to most trading partners besides Beijing?
Yeah, I certainly do. I mean, we had full-blown Mexico and Canadian tariffs of 25% and then 10% on Canadian energy imports for 2 days before we had the reprieve under USMCA. So I certainly do see this as a negotiating tactic to change behavior.
So if you're sitting in the C-suite, why would you make any decisions right now? Which sectors is this going to hurt the most?
Yeah, I think that is probably what we're seeing number one across our clients is from, depending on a sector perspective, like do you wait and see? I mean, industrial products for one, for example, I saw something this morning for, we're not going to make that move in Mexico, right? For a big washing machine plant, right? We're just going to kind of stay put for a while. We're going to continue what we're doing in China. I think, we saw the tech industry deal with this, right? In the first Trump administration, we saw retailers, consumer products sort of deal with this in the first Trump administration. For most of those companies that have, manufacturing in the North American trading bloc, there is considerable amount of uncertainty. And then, from a life science element, when you think about the importance on the transatlantic trade, that is a big element of ambiguity, uncertainty, that really does stymie activity.
Lynlee, this is probably a stupid question, but as I was doing my taxes recently, I was thinking to myself, how do you even begin to account for all of the changes in tariff policies in real time as they come down while trying to reanalyze supply chains?
I think that is not a stupid question. I mean, it's real life, right? I mean, the questions that we got, I think that are really indicative of this are, certain companies that maybe this is relatively new to them, particularly if they've had, free trade agreement benefits. The question was, well, gosh, I imported something within the 2 days that the tariffs were in place. Do I have to pay them? Yeah, you've actually already incurred that liability, so you will be paying them. It's sort of unlucky. Well, then how do I model that on a go-forward basis? What will my continued detriment be? That's when you put in sort of a range, right? Worst case scenario, best case scenario, and you hope for somewhere maybe in between.
Lynlee, are companies just canceling travel as they try to figure out what's going on among employees and say, get back to your desks, crunch numbers, prepare for headlines, and batten down the hatches?
That's a great question. I mean, I think even within the firm, right, the tariff impact is relatively siloed. So many companies have developed these cross-functional task force, which I think is wonderful, to kind of deal with what are the impacts across the institution. But I think from even like the number crunching piece, you can number crunch what happens today, but no one knows what's going to happen tomorrow. I mean, I don't know that when we went to sleep last night and we woke up this morning that we were going to be looking at a, potential retaliation, from the EU. That's new. Like probably people might not have had that in their forecasts when they put their head on their pillow last night, and now they do.
Well, do people have this in their forecast? Reuters this morning is reporting about Canada having retaliation as well. How difficult is the tit for tit to model out?
I think that's a really great question. You can get pretty deep in that. I think a country by country modeling out on an overall aggregate tariff basis, that's algebra. But when you think about a product by product, that gets pretty hairy because you've got, different tariff amounts on different types of products, even sometimes within that same subsection or subchapter of what that product is. I think you could drive yourself crazy trying to get as, exact as possible. But on the tit for tat piece, I think most companies have developed modeling scenarios that allow for that lever to be sort of flexed. Is it going to be 25? Is it going to be 50? What it doesn't allow for is sort of that sensitivity within product levels and across jurisdictions. That's more complex.
Who does their taxes in the middle of the March? Who does that, Bramo?
I'm just saying,
March?
Okay, come on. Really, that's your only takeaway? This was actually incredibly
kind of guy.
Okay. I was about to say, are you actually scolding me for doing it too late? Come on, be realistic.
Brown of EY. No, I'm saying this is early. Mid-March.
Yeah, it's pretty good.
Wait until at least the first week of April.
I like how I was going to pretend like I had done it a long time ago, and now you actually gave me a pass to push it back. So
also, I'm just shocked. I'm just shocked you do them yourself.
Oh, whatever. It's not a big
something you have to outsource.
Why?
It's just easier.
No, it depends how complicated your taxes are. How complicated are yours? What kind of deductions are you getting? What do you want to tell us this morning?
It's easier to
Pretty straightforward here,
We have enough drama. Come on. We've got enough to talk
to the guests. I hope I did, Lynlee. Thank you. Thank you so much. Later on this morning, moving on quickly from that, 8:30 Eastern Time, CPI, big event, big data point. Federal Reserve is a week today. Now, if you have any downside surprises in the economy, tariff uncertainty starts to weigh on growth. Obviously, you're going to see if the Federal Reserve responds to that. The ability for the Federal Reserve to respond to that could come down to what inflation looks like going into that meeting. And we get that inflation report in the next hour.
What's fascinating to me is what Alicia Levine pointed out, that actually if you get a downside surprise when it comes to inflation, you could get a huge rally in equities and in bonds because it basically opens up the Fed to potentially get some sort of reprieve and be able to cut in the face of weakness.
I'm actually interested in PPI tomorrow because that's, of course, the potential inflation we're seeing on these companies and these products. Lynlee talked about something very interesting there. This matter of uncertainty, potentially things could be 2-3 weeks and the tariffs come off. You still pay the tariff. Once that EO is signed, the computers change the border when it comes to collecting the tariff. So how do you model that? How do you pay for it? That could potentially be passed on the consumer immediately.
It's super complicated. I think we know that going into it, but seeing how companies and seeing how countries are responding to this in unpredictable ways, I think Walmart's a great example of that. Walmart says we're going to pressure the exporters, China steps in.
Yeah.
Then the United States is going to pressure Walmart. You're stuck between a rock and a hard place.
So good luck, have fun, call EY.
That's the environment right now. Is that the plug? That's the promo.
Well, I don't know. What do you do with that?
They pay us for that. I don't know. Craig Johnson of Piper Sandler joining us shortly. Flexport CEO Ryan Petersen, Mohamed El-Erian of Queen's College, Cambridge, Andrew Hollenhorst of Citi, and a whole lot more up next.
There's obviously a lot of fear out there in the market, and the fear is centered on uncertainty.
So long as we're in this environment where consumers don't know the rules, businesses don't know the rules, you're going to be challenged for a while.
So far, the threat of tariffs has been a blunt instrument.
The size of the tariffs and the speed of them, it really dwarfs anything that we saw last time around. And I think markets are reacting accordingly.
It will take a few months to see how these policies pan out.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Waking up to new tariffs in the United States of America with the promise of more to come. 25% tariffs on steel and aluminum. And according to the White House, we're still waiting for the big one. The big one comes in early April, reciprocal tariffs. This morning, we're focused on the data. 30 minutes away, the data point of the morning, CPI in the United States, a week away from the Federal Reserve.
Which raises the question, how high is the bar for the Fed to signal that they are open to cutting rates in the face of potential weakness that we see bleeding into the soft data, perhaps into the hard data? Alicia Levine of BNY Mellon was on earlier, and she said that if you get the whiff of disinflation that people were talking about earlier, even if it's backward looking, it will unleash a rally in bonds that opens the door to the Fed coming out and being supportive to the idea of a Fed put.
This is what we need. And we'll talk about why. What's worse than an economic slowdown? An economic slowdown the Federal Reserve can't respond to. the Federal Reserve would be in a position, if they needed to, if the data got worse, to respond to cut interest rates. Because at the moment, you're not seeing anything like that from the administration. We came into 2025 talking about the Trump put. At the moment, I think everyone's asking the same question. What Trump put?
Well, according to Donald Trump, he's not really looking at equity markets, and he says they go up, they go down. It's a great buying opportunity for a lot of people. What they're focused on is bringing rates down, energy down, which they have managed to do. Which why I think today is so important, though, is because he ran on inflation, bringing prices down. What did we hear of Bank of America Institute yesterday? Grocery prices are going up. Well, if you have tariffs on some of your main trading partners, grocery prices may go up even more.
What have we heard from the retailers? The retailers have come out with some pretty tepid outlooks for 2025. They've got no clarity, no visibility whatsoever. But they have warned they might have to push up prices. They might have to pass this on.
And if you look at the internals of the NFIB Small Business Survey yesterday, what you found was that the largest share in nearly a year of these businesses, so that they plan to raise prices in the upcoming months as a result of some of the policy shifts. Again, it sort of raises the question of what the Fed will be looking at and how high that bar is for them to respond at a time when a lot of people seem to be predicting much slower growth.
Small business confidence at a 4-month low. It's hard enough working out what these tariffs will mean for the economy here in the United States. Working out how other countries will respond isn't straightforward either. And we've seen that from Europe and Canada in the last 24 hours.
Canada this morning, according to Reuters, is saying they're going to respond to the 25% aluminum tariffs and steel tariffs. Europe also suspending some of the tariffs they had on goods like whiskey and bourbon, motorcycles, and then they're going to meet collectively in mid-April. We can get even another response, although it does seem that they are also offering up a path for negotiation. What I find so striking about what Europe is doing is, Jonathan, you mentioned taking a playbook from China. They're going after red states.
Well, it took 5 weeks, but Wall Street took a look at all of this, and last week started to make their downgrades. And this week it's accelerating, and we got that from Goldman Sachs. And it wasn't just the tariffs. It was the idea that we're talking about which ones, the retaliations, what the goal is. And the fact is that if you have that kind of uncertainty, you need a higher risk premium on your assets.
It's not just the market, it's the economy too. The downgrades on both. HSBC downgrading US stocks, Citi doing the same things. Lisa just mentioned Goldman. Goldman have done it on the economy as well. That call on the S&P is built on the call from the economics team, cutting the growth outlook. Morgan Stanley, Mike Gapen, downgraded growth, upgraded inflation. Deutsche Bank warned about the same thing. Considerable downside risks amounting. We'll get more data through the week.
And Julian Emanuel pointed out that right now he sees the market pricing in more of a stagflation type of environment, which has a downside on stocks of about 10%. They're not taking the recession calls fully seriously yet. Should those come into play, you have a much bigger potential downdraft.
Equities doing better this morning, though, up by 0.75% on the S&P 500, snapping back after 2 days of losses on the benchmark in America. Coming up on the program, we'll catch up with Craig Johnson of Piper Sandler as a new round of tariffs takes hold. We'll speak to Ryan Petersen of Flexport on how the levies will impact supply chains. And we'll speak to the brilliant Mohamed El-Erian of Queen's College, Cambridge, reacting to the latest read on inflation. We begin this hour with stocks rising as President Trump downplays the risk of recession. Craig Johnson of Piper Sandler writing, another round of distribution pushes the stock market into a deeper short-term oversold condition, from which a meaningful rally of 3 to 5% can occur soon. Investors should be very selective. Craig joins us now for more. Craig, welcome to the programme, sir. Thanks for giving us some time. Let's talk about that so-called technical damage. How much damage have we done?
We've done a lot of damage. And again, thanks for having me on the show. But we've done a lot of damage over the last 19 to 20 days. We have seen the S&P pull back over close to 10%. And if you break below the surface of this market, you start to see that you've got a lot of stocks that are off more than 20%. In fact, if you look at a market cap range between 20 and 80 billion, you've got nearly a third of the stocks that are now 20% off of their 2024 highs. So the damage has been swift. It has been pretty broad. And at this point in time, this market is setting itself up, though, for a pretty good relief rally. Could be 3 to 5% back toward the 200-day moving average on the S&P 500. But clearly, the conditions are ripe for at least a relief rally. And again, I'll say that at minimum, a relief rally, maybe even a little bit more.
Craig, before we talk about single names and what you're screening for at the moment, can we just say at the index level, we spent a lot of time above the 200-day moving average. Where do you find support now?
Well, support right now could be as low as 5,400 when you're looking at the S&P 500. But again, the relief rally is setting itself up, and there's been a long upward trending price channel that's been intact coming off of those 22 lows. And that price channel was violated just a few days ago. Got to keep in mind, though, from a technical perspective, that sometimes you break that level, as long as we're not going to break it for 3, 4, 5 days, and you see a snapback through that, sometimes the computers kick in and say, hey, now is the time to buy. There's been a lot of investors out there that were waiting for a pullback through much of 2024, never got it. Now you got a 10% pullback. I think they're going to start looking at that as a little bit of a potential buying opportunity for select names. And to that point, when you look at what happened yesterday, we saw our mother's favorite index, the Dow. It was down meaningfully yesterday. But when you started looking at small, mid-cap growth names, things like AppLovin, stocks like that, they were actually up materially yesterday in what looked like a pretty heavy tape. So again, I think there's some select opportunities out there that investors are looking for.
Just to build on what you're talking about in John's question, do you still have that year-end target of 6,600 if you do break below that level for a longer period of time, or say there isn't a broader participation outside of those select opportunities that you see?
Yeah, we're sticking with our 6,600. We established that target back in November of 2024. Certainly, we don't think that 2025 was going to be a great year to begin with. Typically, the third year of most bull markets, you only get an average return of about 5.2%. And that was sort of in our thinking as we were thinking about 2025. So we sort of laid out a kind of high single digits price target when we established that. Yes, now it's certainly higher than where we are now. It's about 12 to 13-ish% from where we are now. But again, I think that's a reasonable objective. I'm not in the camp right now that we're going to see stagflation or a recession at this point in time. Need to see more evidence of that. And again, I'm not the economist. I'm the chart guy. And as I come back and I look at all the charts, there's a lot of stocks that are pulling back to sort of identifiable support levels that I think investors are going to probably want to step up to.
So let's talk about some of those. I'm looking right now, and you have a range of different sectors represented, whether it's financials and Morgan Stanley or it's tech and Oracle. What kind of technical levels are you looking for? Or is there something fundamental that's happening that's giving you some optimism?
Well, I take the sort of stance that a lot of the fundamentals are going to get priced in through price itself. And so when we come back and you look at something like a Morgan Stanley, and let me just step back and say where we think investors should be right now is they should be overweight tech, just not the Mag 7, because we think the Mag 7 is going to be the Lag 7 in 2025. We also think they should be overweight financials, and they should also be overweight some of the services companies. And one of the names that we did call out was Morgan Stanley. And if you step back and not look at a daily chart, but step back and look at a monthly chart, you can see stocks like Morgan Stanley have corrected materially, but you're back to long-term sort of support levels. And that's where these kind of stocks can find their footing, whether it's Oracle on the tech side, whether it's Morgan Stanley, or some of those kind of names. But that's what we're looking for. And that's what a lot of our investors are asking us for. Craig, find me stocks that have pulled back to material support that still look constructive.
Good to catch up, Craig. As always, appreciate your time, sir. Craig Johnson there of Piper Sandler on some of the technical damage we've seen over the past week. Finished on financials there. Banks have had a really tough ride of it through 2025 so far on a handful of names over the last week or so. We talked about wiping out all of the gains post-election on the KBW Bank Index since early November. A lot of that's come from some big names, Lisa, and it goes beyond the traditional banks. It goes to the Apollos, the asset managers as well.
And you could argue it's the ones that were the highest flying in the wake of the election are getting now the most beaten up. And it goes to this point that we were talking about earlier, how much of what we're seeing is simply a momentum unwind versus some fundamental shift in overall trajectory of the economy. Right now, it seems like people are looking for gains. Let's see how much those dollars can take hold, because we are hearing from a number of retail investors that is the case this year.
Bank of America so far this year, down about 10%. JP Morgan's down about 4%. Deutsche Bank, up about 25%.
Well, yeah, if you take a look at the European banks, they're
versus the
absolutely
US,
flying.
It's absolutely mental. They're the year-to-date moves at the moment, as you can see. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. The Trump administration is set to nominate Fed Governor Michelle Bowman as the next vice chair for supervision. A person familiar told Bloomberg that the announcement could come as soon as today. Previous vice chair for supervision, Michael Barr, resigned from the role last month. Elsewhere, Canada is suspending plans to add a 25% surcharge on electricity exported to Minnesota, Michigan, and New York. Following that suspension, President Trump dialed back his threats to double tariffs to 50% on Canadian steel and aluminum. Ontario's Premier Doug Ford and U.S. Commerce Secretary announced a meeting tomorrow. Elon Musk is appealing to have his $56 billion pay package restored. The Tesla CEO is claiming a lower court made multiple legal errors in rescinding his 2018 compensation package. Last year, a judge revoked the pay package, ruling it was unfair because the company's directors were beholden to Musk at the time. And that's your brief. John.
Danny, thank you. Appreciate it. Thank you so much. Up next on the programme, the morning calls. Plus, we'll speak to Ryan Petersen of Flexport as shippers brace for tariffs, then more tariffs, then maybe lower tariffs, and then higher tariffs. And then who knows? From New York City this morning, good morning. US CPI, 18 minutes away. 16 minutes from now, inflation data in America, US CPI just around the corner. The scores going into it look like this. We're off the back of 2 days of losses on the S&P, set to snap that if we hold on to these gains, and we'll see. We're up by 0.75% on the S&P, on the Nasdaq 100 up by 0.9%. The scores in the bond market shaping up as follows: 2-year, 10-year, 30-year. Yields higher by 3 basis points. The 2-year pushing 4%, the 10-year up 2 basis points to 4.30. We are in the quiet period for the Federal Reserve, but the chairman had the final word going into the weekend, and he said we're not in a hurry. But would it give him some space if we got a downside surprise on CPI, just to change the tone a little bit at the Federal Reserve meeting a week today?
That seems to be what the market is expecting, that the market will dictate and the data will dictate how quickly and how long the Fed can wait before responding. The difficulty with this is it's backward looking. And not only that, but when we look at some of the surveys that show fast moving trends, it shows that companies are planning to raise prices at a rapid pace. And that is potentially problematic at a time where the Fed has a dual mandate and has inflation that is hotter than that 2% goal.
Christine Lagarde, the ECB president, was speaking earlier on this morning at what they call the ECB Watchers Conference. It's a get-together for all the economists who follow the ECB. There's a lot of them. They do this in Frankfurt every year. I've been. It's very boring, but you do hear from the ECB president. And they talked about the era of shocks. And it is an era of shocks. And she talked about the difficulty of maintaining stability in a moment like this one. And I do have some sympathy for them. They don't know what the policies are going to be. They don't know how they will change from day to day. They don't know how other countries will respond. So you can't offer forward guidance in that environment. It's very difficult to do that.
And it's difficult to act with the word that she used, agility, if what you're trying to move is a massive train. And frankly, each of the calibrations to policy take time to come through. Again, it's a mismatch of timeframes. If you can slap tariffs on, take them off, put them back on. How do you respond to a potential growth shock that may or may not come through if you're someone who's working on a 6 to 12 to 2 year time horizon?
The multiple you're willing to offer on stocks obviously shifts, right? Which is kind of the point that Goldman were making earlier on this morning, the point that you were making too.
The idea that if you have higher volatility, that means that the risk reward changes because the risk goes up. So the reward might not be. It has to be even greater for you to get in.
Equities up this morning by 0.8%. The data just moments away. Let's get you some morning calls. First up, Jefferies downgrading PepsiCo to hold, saying the stock's current price offers limited upside. That stock is moving to the downside. We're lower by 1.3%. Your second call from UBS, lowering its price target on Coles to $5. The firm's seeing a challenging consumer environment that's likely to persist. Only just positive there by 0.2. And finally, Morgan Stanley lowering its price target on Apple to $2.52, expecting a flatter upgrade cycle and bracing for the impact of China tariffs. The stock is just about unchanged. That really is one to watch. Let's stick with tariffs. Global supply chains bracing for the impacts of President Trump's levies. Ryan Petersen of Flexport writing, if imports become more expensive and unreliable, it could indirectly boost US manufacturing. But if US exports become too costly, US manufacturers will struggle to compete globally. Ryan joins us now for more. Ryan, it's good to catch up with you, sir. It's been a number of months since we last spoke to you. Just walk me through your thoughts on the latest changes, and they change often.
I think that's the hardest part for supply chains. Sort of need some certainty. They take a long time to set up and to plan. And so if you're in a position where you don't know what's going to happen next week, next month, it's a bit of a paralysis that can set in. I mean, companies, everybody, it's very clear that the administration and also the prior administration has been very clear that trade with China is going to be faced with higher duties. What's less clear is whether that's going to be true for Vietnam, Malaysia, India, and many other trading partners. we have to sit and wait and see. But if they're putting tariffs on Canada, you can expect there's really no safe haven out there for tariffs other than manufacturing right here in the United States.
Ram, we've seen some evidence, just looking at the trade data, of some front-loading in activity to start 2025. You seen the same thing in your business?
We saw a lot of that at the end of last year. Yeah, once even under the Biden administration, when they put in higher tariffs on steel and aluminum, there was a big push. If you could move the goods in beforehand, you did. We have seen quite a bit of that, although at this point, April 1st is the deadline for the Treasury Secretary to present a report to the president on unfair trade practices by China. And that's when we would expect more tariffs to come out. Well, April 1st is around the corner. It's a little too late to get at this point to keep front loading before that happens.
Given what you saw during the pandemic when it comes to supply chain and logistics, do you think companies are more prepared now than they were, say, in Trump 1.0?
Well, on some level, the executive leadership teams of companies has a lot more experience dealing with logistics and tariffs, and they're more in the weeds than they were a few years ago. They sort of just took this for granted, didn't pay a lot of attention to the logistics department, transportation department of their company. Now those, our customers, which are these transportation departments, logistics departments, as one of the largest freight providers in the world, we work with these people every day. They're under the hot seat. They're talking to their leadership all the time. The CFO is breathing down their neck trying to understand it. So in that sense, yes, but not a lot has changed. The ports they don't have a higher throughput than they did 5 years ago, about the same. There aren't larger safety stocks of inventory for the most part. So I don't think we're a lot more prepared than we were in the past.
The president continues to say, and he said this last night at the Business Roundtable, that you need the tariffs to bring manufacturing home. When it comes to supply chains, do you see any evidence that that's happening right now?
Yes, I mean there's a lot of manufacturing happening in the United States, and it's reindustrializing relatively quickly. It's too fast? It's too soon to say, oh, it's happened, as a result of Trump administration. But there's a lot of tailwinds for manufacturing in the United States. In addition to, you have the carrot and the stick. I mean, the stick is tariffs. It's going to be more expensive to import from other places. The carrot is going to have to be things around deregulation and making it easier to manufacture. And on top of that, I think there's some tailwinds with robotics that may make things, pretty exciting actually, and make it less about cheap labor. But those are going to take many years to play out, so it's a little too early to say.
You made a point, Ryan, in your notes, and this is something that John alluded to, that on one hand, it could increase domestic production, but it could decrease the ability for those manufacturers to export some of those goods if you have a more complicated trade mechanism. How much are you seeing exports from the United States dropping off, if at all?
Well, that's been a long-term secular decline. So if you look at the containers entering, and we're in the container shipping business, so we help companies move goods by ocean freight, by air freight too. But look at the containers. If you went back 20 years, for every 10 containers we imported, it was about 8 of exported goods. We're down to about 2. So most of the containers, you see a container ship leaving the United States, 8 out of 10 of those are empty. So I don't think we have a problem of too much exports. That'll be a long time before that's the case. They are, one of the rules in the U.S. Trade Representative Office has asked for comment. So you have until March 24th, if you're an American business, to submit your comments on this. But they have a new proposed ruling that would require American exports to travel on American-made ships, that 15% of exports would have to go on a U.S.-made ship within 7 years under this proposed rule. Well, the reality is there's not a lot of American-made ships. We're making about 20 a year total. And that counts oil tankers. That's not just container ships. So you just don't have enough ships that would be kind of a pretty disastrous policy in my view, because we're trying to promote, or the government's trying to promote, American manufacturing. And if you're limiting the exports, as a function of how many and how large are the American-made ships, that's going to really hurt American manufacturers. So hopefully that doesn't pass. It doesn't get put through as an executive order. They're asking for comment right now.
Ryan, one thing that we keep hearing from a lot of analysts, that companies can deal with tariffs. They just need to know what they are, and then they can plan for them. Is that your takeaway too? Is that your comment during the comment period to the administration?
That's one of them. I mean, the reality is no one cares what I think about tariffs. Like I'm very anti-tariff. It hurts our customers. It's not good for business. I think I believe, I'm a big believer in free trade and human freedom, let you trade with whoever you want to trade with around the world. But there's plenty of good arguments for it as well. That's fine. My point of view is exactly what you say, is like, well, just get it done with quickly so we can all get back to planning and set up our supply chains, according to the policies. But when it's changing constantly, it's much harder to figure out what you should be doing.
Ryan, just on that premise, you think you should be able to trade with anyone around the world, even if they're not playing by the same rules?
Well, in a pure, the purest form of it, sure. But obviously, I don't believe that we should trade with America's adversaries in North Korea and other folks who are, committing all kinds of rights abuses or whatever else. So we need some rules. I also think that reciprocal tariffs is relatively reasonable policy, frankly. Like if a country has really high tariffs on American-made stuff, and we have free trade on our side, that's not very good negotiation. So I don't think we live in this black and white world where it's that simple. But at its extreme, yeah, I'm a free trader.
Ryan, appreciate it. Appreciate your stance. Ryan Petersen there at Flexport. You said China without saying China, right?
I did, yeah.
Because that's the wrinkle in the story, and I'm with you. When we had Trump Volume 1 in the first term, Larry Kudlow, the then NEC director, would come on the programme and he'd talk about reciprocity and the lack of reciprocity. And I think the argument resonated with a lot of people. In fact, their push when it came to China basically united Washington, D.C. at a time when Washington was very divided. It was the one issue that most people agreed on. It just feels like the goalposts have shifted in a second term in quite a marked way. We're talking about a whole host of things beyond just reciprocity.
Right, but when it comes to these tariffs that some have been put on and taken back, the ones that continue to stay, the ones that are steadfast, are China. And this potentially, what I hear, is just the opening salvo when it comes to this 20% on China. And the interesting point is, in Washington, D.C. now, following Trump Volume 1, it would be hard-pressed to find anyone who's anti-going after China. Remember, those are the tariffs that Biden kept in place because national security concerns outweighed the economy.
Coming up in just a moment, it's 5 minutes away. US CPI, breaking inflation data in America. Look out for that in just a moment. Breaking things down, fantastic lineup for you. David Kelly of JP Morgan, Mohamed El-Erian of Queen's College, Cambridge, Andrew Hollenhorst of Citi, all here to react. And later, we'll catch up with David Rubenstein from New York City. The data drops next. Futures near session highs. This is Bloomberg. The economic data is 25 seconds away. Going into CPI, your scores look like this on the S&P 500. Equity futures near session highs, up by 0.8% on the S&P, following 2 days of losses. On the Nasdaq 100, up by 1 full percentage point. In the bond market, 2-year, 10-year, 30-year. Your 2-year, 398, yields up 4 basis points. Your 10-year up 3 to 430. With your economic data, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, we come in with a little bit better news than everybody was expecting, with CPI on a month-over-month basis just up 0.2%, and the core is up just 0.2%. That pushes the year-over-year CPI down to 2.8% and the core down to 3.1%, suggesting that the Fed could start making a case for additional rate cuts if they wanted to, and they may have to, given what's going on in Washington. We'll get the breakdown for you later this morning.
Mike McKee, thank you, sir. This is a very important data point for the Federal Reserve going into that meeting a week today. The equity response is obvious, like a rocket. Equity futures up by 1.6% on the S&P 500, higher across the board. Check out the Russell. The small caps up by 2 full percentage points. In the bond market, yields lower. They were higher. We're down 3 basis points at the front end. The 2-year, 391. Push it through the FX market. We unlock 109 on euro dollar very briefly. The euro at the moment erasing losses on the morning so far, 109.16. It's a downside surprise on CPI.
The reaction in stocks is bigger right now than what I'm observing in bonds, which is telling. It's that maybe stocks are looking for where the Fed reaction or where the policy response might be. Right now, the hope is leaning more to the Fed than maybe to Washington, D.C.
Joining us now is David Kelly of JP Morgan Asset Management. David, that's some good news going into next week. How much comfort will this bring the Federal Reserve?
Only a little. I mean, if you look at the numbers today, just scanning them, we saw a 4% decline in airline fares, which is probably, that reflects some of the things that the airlines are saying to us about some weakening in demand. But I really think that the Federal Reserve is in a very difficult position here. Until we have some clarity on tariffs, they don't know how much of an inflation kick we're going to get from tariffs this year. And until we've got some clarity on the budget, they don't know how much fiscal stimulus is going to be kicked in next year. So I still think they'll probably wait and see next week. This economy is beginning to look like it needs or will, justifies a rate cut. And I do think we'll probably end up with more than one rate cut this year. I think we may end up with a sequence of rate cuts. But I think it's just too early for the Federal Reserve to make a decision, given the uncertainty about policy.
What's fascinating to me is the reaction in markets, David, the idea that you're seeing a bigger reaction right now in equities than you are in bonds, this idea that maybe the Fed could come back into play and support valuations even amid policy uncertainty. Do you buy that? Is that something that you think is a correct thesis?
Well, I think that there's some other things on the bond market's mind here. I mean, one of them is that if you look at the numbers that the CBO put out yesterday on the budget deficit so far this year, it looks like we're going to crack $2 trillion this year. I mean, we've got a massive budget deficit. And the weaker the economy gets, the more likely it is that we're going to see even more fiscal stimulus kick in next year. So we've got a deteriorating fiscal situation here, and slower economic growth and tariffs will only make it worse. So that may be supporting real yields here, even if inflation backs off a bit on weakening economic growth next year. So I think there's more than just inflation and the Fed on the bond market's mind.
Which is also a part of the reason why the Fed might have a hard time just embracing this data and then signaling next week that they plan to cut rates sooner than maybe they expected. David, what do they need to see to have confidence in the forward trajectory, given that this is backward moving and we have policy that is pushing companies to act in real time?
Yeah, I think the most important thing would be a sort of a final story on tariffs for this year and for the next few years. We know, obviously, as an economist, I believe that zero tariffs are the correct policy. I think that's a fairly traditional conservative perspective. But some clarity on that is vital for them to figure out, how's the economy going to evolve? I mean, what the Fed has said very clearly 2 days after the election, Jay Powell said, we're not going to assume, we're not going to guess, and we're not going to speculate. But they'd have to assume, guess, and speculate if they move policy right now. And that's what they're trying to avoid. So that the administration and Congress really need to figure out what the policy playing field is going to be over the next few years. Then the Federal Reserve can try to make some decisions.
David Kelly of JP Morgan Asset Management. David, thank you. The Federal Reserve meeting a week away. David really painted a picture of what a tricky position this Federal Reserve is going to be in a week from today. It could have been trickier without a data point like the one we just got.
At least they don't have runaway inflation, or the idea that coming into a potential inflationary shock, albeit a one-time price adjustment, there is some sense of disinflation. That said, the fact that if you do have a weakening economy, that could lead to more fiscal stimulus makes it very complicated for bond investors, let alone just the Fed.
If you are just joining us, welcome to the programme. Moments ago, a small downside surprise on CPI. Headline month over month, 0.2%. The estimate, 0.3%. Stripping out food and energy, 0.2%. The estimate, 0.3%. To discuss this and a whole lot more, joining us now is Mohamed El-Erian of Queen's College, Cambridge. Mohamed, welcome back to the programme, sir. Good to catch up with you. Important data point. How does this change things, if at all?
So if you talk to economists, they'll tell you looking back, it's good news. Looking forward, there's very little information content because of what David just said, what we've been discussing all day, is we don't know what the pass-through of expected and actual tariffs will be. So that's why the economists are. For those in the market, having been disappointed on the Trump put, this is better news on the Fed put. And I think that's why you're getting such a strong reaction on the equity side.
There's been so much confusion, Mohamed, about tariffs in the past 24 hours or so. You wear several hats, one of which is you've been a business leader for many, many years. And I think you made the important distinction when we had the boom of inflation. You made the point that this was not going to be transitory because of what you saw at the corporate level, how companies were acting and how they were responding. Given the threat of higher tariffs still to come, what do you see now from companies? And what does it indicate to you about what data might look like in months and quarters to come?
So two things are obvious to me, John. One is that companies have gone into a wait-and-see attitude, and understandably so, especially if you're a multinational. You need clarity. So you're postponing decisions because you don't want to make a decision that ends up being a big mistake because the world has changed on you. So we are seeing business activity slow down. The second thing we're seeing is people are much more ready to pull the trigger on price increases than they were in 2021, 2022. So if these tariffs stick, and if we get more tit-for-tat trade issues and things like that, then the pass-through to prices will be quick. And it will come at a time when demand is softening. So then you bring the third issue, which is the consumer. The consumer is hesitant already. I take seriously what you've been saying, all of you saying about what's happening to airlines, what you're hearing from different retailers. There's been risk aversion, clarity on the sense of the household. So put all that together, John, it is a wait-and-see economy that cannot absorb much of a price hit.
Is it an economy that could potentially enter a recession this year, Mohamed?
My probability is 25 to 30%. It was 10% at the beginning of the year, so there's been quite a big change. Why isn't it higher? Because there's a lot good happening in the U.S. economy as well. But if we get a prolongation of policy uncertainty, then that probability will go up.
There's a question about the response from central banks globally, Mohamed, if you do have this environment where inflationary pressures are going to be stickier at the same time that you have slowing growth. Christine Lagarde called it an era of shock and saying that maintaining stability in a new era will be a formidable task. If the central banks around the world had to choose, what's worse? Allowing inflation to be a little bit hotter but trying to help growth, or suppressing inflation at the risk of not rescuing growth and allowing it to continue to plummet?
So for both Europe and the US, it is the former. These economies can get to stall speed pretty quickly. We don't want that because the damage that creates is significant. So tolerating slightly higher inflation would be the better choice, the way you framed it. But Lisa, remember, these are central banks that made a huge mistake. And they may be much more sensitive to inflation than we would be, given the mistakes they made.
The idea of transitory and not maybe responding to it in the way that maybe they should have. I'm just wondering if, let's say they did take what you just said seriously, and they did say, look, we're going to have to just tolerate higher inflation for longer, and we really need to address slower growth. How many times would you expect them to have to cut this year in order to offset some of the uncertainty and, frankly, the consumer demand destruction that we're seeing in real time?
So to be clear, if 2% was really the operative inflation target, we wouldn't be speculating on how many cuts. We would be speculating on the timing of the hike, because the data has stalled for quite a long time. But because most people believe that 2% is a medium-term to long-term target, there is speculation on how many cuts. I'm in the one camp. I think, given what we know today, we get one. Now, if the tariff tensions persist and tit-for-tat get worse, I mean, at some point yesterday with Canada, we were near tipping points. And that would have forced the Fed to revisit what it's thinking right now about rate cuts. So it really depends where this trade war goes, Lisa.
Mohamed, I want to revisit one of your best calls. You are probably one of the best risk managers that I know, that's for sure. I want to talk about February 19th. February 19th, all-time highs. And not the February 19th all-time high of 2025. The February 19th all-time high of 2020. And I remember you came out around that time and you said, don't buy this. Now, the equity market is corrected in 2025 10% from the all-time highs of February 19th, and it's quite a parallel to think about those two dates. Mohamed, what would your approach be to markets now and equity specifically?
So I'm asked this all the time, John. I was asked this morning by someone here in the college. Is it time to buy? It's very tempting to buy because with 10% off on the S&P, with 13 to 14% off on the NASDAQ, I respond very simply. What mistake can you not afford to make? You know, most mistakes in the investment world are forgivable over time. And that's the great thing about the investment world. If you bet on something that defaults, that's a different issue. So investors need to understand how much tolerance do they have for short-term mistakes and how much tolerance do they have for volatility, because the probability of both these things has gotten a lot higher than it was at the beginning of the year.
Mohamed, appreciate your time. You're one of the best. Thanks for catching up with us. A good friend of this programme, a good friend of ours, Mohamed El-Erian of Queen's College, Cambridge, on some of the latest market moves and the latest economic data. If you are just joining us 11 minutes ago, CPI just dropped in America. Michael McKee is back with us for more. Mike, second read of things, what jumps out?
Well, obviously, and this was mentioned, airline fares were the biggest drop, over 4%, and at the same time, used rental cars rather fell. So it looks like travel cut back somewhat during the month, and we saw that reflected in the airlines yesterday in what they were saying. Eggs were up 10%, still rising during the month of February. That contributes a lot to a 2% rise in food. Coffee also up. Bacon was down, the one good part there. We were looking through these numbers to see if there was any kind of pull forward on tariffs, and it doesn't look like it at this point. That people were trying to bring in a lot of stuff, and that caused the price to go up. Toy prices actually went down on the month, and that suggests that we got to wait till maybe tomorrow's PPI to see any kind of effects like that.
Mike McKee on the latest economic data. If you are just tuning in, small downside surprise relative to expectations. Equities off like a rocket after that print. As often happens, though, sometimes these moves don't stick. Those moves fade. Still positive and near session highs on the S&P relative to where we were before the print. We're higher by about 1.1% on the S&P 500, up by 1.4 on the Nasdaq. Yields were a little bit lower off the back of this story, now higher by 3 basis points on a 10-year to 4.31, and at the front end of the curve as well. We're back to about 3.97. Joining us around the table, I'm pleased to say, Andrew Hollenhorst of Citi. Andrew, good to see you, sir.
Good to see you.
When you walked into the studio, Lisa asked you a question. It was the title of your recent note. Is the Fed still in a good place? So let's ask you that question. We've got an update, got some data. Is the Fed still in a good place?
I'm not sure that they are, John. I don't know that they're going to recognize that at the upcoming FOMC meeting. It may be more of a wait-and-see meeting. But if you think about where they are, they've had policy at a restrictive setting because they've been trying to wring the last few basis points out of too high inflation. And you can do that as long as growth is resilient. But now we have some questions about whether growth is resilient. So I think they will be reducing policy rates. You would at least want to get back to neutral.
If I was on an investor committee right now, I'd want to be speaking to the economist and then the person who was managing rates, because I want to know why yields are up off the back of a downside surprise on CPI. Can you figure that out for us? How does that make sense? What's the overarching fear here that's dominating things, that's really in the driving seat? Because it doesn't seem to be this data point.
Yeah, I think we really are looking to the growth data. On the inflation side, I think is that weakness that we're seeing in inflation this morning, if it's in airfares, if it's in some of these more transitory, to use a term, if it's in some of these more volatile categories, that's less relevant. What we're really looking through to is what's PPI going to be tomorrow? What's PCE going to be at the end of this month? Where are shelter prices running? Where's that underlying trend in inflation? You really want that under control because we do have these upside risks from tariffs.
You know, Mohamed El-Erian keyed on a point that I think is really important. He's saying that probably this Federal Reserve and frankly the ECB should prioritize addressing growth concerns, even at the expense of pushing out the timeline for when inflation will get back down to 2%. And it seems like on some level, the Fed had been doing that and then got burned with transitory. So there's this question of, are they going to do something different this time and remain on hold for longer, not addressing growth concerns because inflation is sticky and has been?
So I think they're trying to develop a framework around this, around what would be a so-called one-time price effect that you could look through, a price level movement that you could look through. And if you see underlying inflation in things like shelter and other categories that won't be affected by tariffs, if those are staying cooler and you see inflation expectations that stay anchored, then you can be cutting even if you're technically above target in terms of core because you had this one-time price level effect. And I think that was the mistake that they made in the earlier inflation episode because we actually saw inflation across categories and we were still calling it transitory.
So this is actually really important, and it goes to this idea of, do they adopt a 2-point-something kind of framework of inflation that they will accept, and talk about the importance of avoiding a long-term stalling out that could be potentially much more pernicious for the economy. Is that what you think they're going to have to do to explain some of their actions in a non-political way and in a completely politically fraught moment?
Yeah, I don't know if they're formally going to adopt that as a framework, but I think this kind of intellectual development of this idea that, yeah, you can have some months where you're running at 2.5% inflation, slightly above the target if you think it's a one-time movement above the target. That's important.
So you have come out, and you came out last year, and you said the economy is going to weaken a lot more than people expect, and you expected the Fed to be cutting pretty aggressively.
Have you seen anything in the data so far that highlights that view, that it has been a very weakening economy going into this period of uncertainty, regardless of the tariffs? Kind of Neil Dutta's point.
We saw a lot of resilience over 2024, but we also saw signs that things were maybe not as healthy as they looked. Some of the things in the labor market with a low hiring rate, delinquency rates that were rising for consumers. So we knew that underlying softness was there and might get triggered at some point. And now as we're coming into 2025, remember, this is data that's really before we had a big concern over tariffs, and we're seeing consumers that pulled back in January. We have all the anecdotes from the retailers and the airlines. So it does look like that weakness was catching up with the economy, and that was before we were hit with any kind of new shocks.
So make us a forecast. FOMC's got to put out the SCP next week. How tough is that going to be?
Very difficult. I don't think that they want to surprise the market hawkishly here, and the market's pricing a little more than 3 rate cuts in for this year. So I think that dot for the end of 2025, that median dot, I think will show 3 rate cuts instead of 2.
How do they engineer that? They all get around a table and say we can't do this? Do they actually independently put through forecasts and then we look at the median, or do they sit together and say, well, you've said this, you've said that, we need to make it this? How do they even do that?
There are a lot of bilateral conversations that go on, then they all meet together. Somehow it all works out.
Bilats.
Andrew Hollenhorst of Citi. Bilats at the Federal Reserve.
Yeah,
We've seen them in Jackson Hole.
Yeah.
They are
It's
real.
true. Yeah, go for a
sideline chats.
It's true, bilat hikes.
Not going to name names, but they are real. Let's get you an update on news elsewhere this morning. Here's your Bloomberg Brief. Let's cross over to Danny Berger for more. Hey, Danny.
Hey, John, just to revisit that CPI data coming in softer than expected in February. It rose at the slowest pace in 4 months. Core CPI up to 0.2%. That is slightly lower than the estimated 0.3% in our survey. The Bureau of Labor Statistics said nearly half of that advance in the overall measure was due to shelter. Elsewhere, House Republicans passed a bill to keep the government open past a Saturday shutdown deadline. The bill will likely need the support of at least 8 Democrats in the Senate to become law. If it fails in the Senate, Republican leaders could try to pass a shorter-term stopgap later in the week. And in sports, Tiger Woods will likely miss the Masters tournament next month. The 49-year-old posted on social media that he underwent a procedure on a ruptured Achilles tendon. He said the surgery was minimally invasive and went well. Woods set the Masters record last year by making the cut for the 24th time in a row. And that's your brief, John.
Hey, Danny, thank you. Appreciate the update. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. A lot to get through. And looking ahead to next week, a week today, the Federal Reserve has got to get together and put out some forecasts. How do you put out some forecasts when you don't know what policy is going to be and it can change from day to day and within the day 5 times with great difficulty? Equity futures right now in the S&P positive by 1 full percentage point. The opening bell is about 41 minutes away. The opening about 37 minutes away. Equity futures going into it, holding on to gains. Post CPI, equities firmer here by 1.2% on the S&P, up by 1.6 on the Nasdaq. If you are just joining us, just tuning in, CPI came out at 8:30 Eastern, so about 23 minutes ago, and it came in a downside surprise. It's 0.2%. The estimate was 0.3. That's on both headline month over month and on core. So equities off the back of that, just a little bit higher. Let's talk about the week ahead, the day ahead. Here's your trading diary. At 10:45 Eastern Time, President Trump meeting with the Prime Minister of Ireland. Thursday, PPI and another round of jobless claims. Friday night, the US government shutdown deadline. Look out for you, Mitch, that day as well, earlier on in the morning. Sneak peek of next week for you. Retail sales on Monday. Another big data point, an important one, going into the Federal Reserve on Wednesday when they deliver their decision. Talked about equities and reaction to CPI. Just want to talk about the bond market briefly. Mentioned this earlier on in the programme. This is what's so difficult for a lot of investors right now. Bonds are behaving in really unpredictable ways. So if I said to you going into this print, what would yield to look like if we got a downside surprise on CPI? You might say, yeah, I want the details. I'm not giving you them. I just want to know, what would it look like post CPI on a downside surprise? And most people would have said lower yields, and that lasted about 10 seconds.
Which is really fascinating to me. The bond market is getting a different message. They're looking ahead. They're seeing less than 3 cuts now being priced into the market from the Federal Reserve. They're seeing the forward look as being potentially more inflationary than the past look. And they're saying the Fed might have a more complicated decision ahead of it than what maybe the stock market is suggesting.
You have to think there was a sigh of relief when you saw the downside surprise on inflation come in, and then all of a sudden, oh no, but we want rates to be lower. So a bit of a whipsaw, I imagine, going on in the minds of Scott Bessent this morning and the president. I take away from all of this after yesterday's 24 hours, the market is desperate for clarity, and they're not going to get it with this president.
It's a policy-driven market, and that policy has been driven out of the White House. We spoke to David Kelly of JP Morgan just moments ago. Asked David whether this would bring the Federal Reserve any comfort going into next week. He said maybe a little bit, not much.
They need to look forward. The problem is, and this goes to Mohamed El-Erian's point, if you get consumers that are already retrenching some of their spending, do they need to come out and say, look, we're not targeting 2% this year. We have a different framework. This is what it is, and we want to support the economy.
Coming up tomorrow, the conversation continues. John Stolfus of Oppenheimer, Greg Dacko of EY, the former trade official, Katie Kalukowicz, and Dirk Willer of Citi. Look out for that one. Citi downgrading US equities in the last couple of days. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special BNP Paribas Open update for Bloomberg TV and radio from Tennis Channel. Defending champion Iga Świątek made short work of her fourth-round match against Karolina Muchova. The Polish star took under an hour to put the win in the books, dropping just 2 games on her way to the quarterfinals. Świątek is looking good to become the first woman to win 3 titles in the desert.